Good morning, my student friends. Once more, we are back with one more session for intermediate. The session today is taxation. I hope that all of you are enjoying the virtual classes that the Board of Studies is bringing for you. As I have said last time, what is very important is your feedback. Because once you give your feedback, we can see how the virtual classes are going, to what extent the virtual classes are useful to you. Please note that since you are intermediate students, we have also got an e-book out. Take full advantage of the e-book. Today, we are going to release the mock test papers. The first set of mock test papers we are going to release today. Study them, appear for them. Within 48 hours, we shall also release the suggested answers to that. So have a look at the suggested answers. Tally the answers that you have written in examination condition. We suggest that you write them in examination condition. And tally that with the suggested answers that the Board of Studies will put up in 48 hours after they release the mock test papers. Please take full advantage of the mock test. And I'm sure, you will benefit from it. Speaker after speaker have been telling us that it's so important that you, make a practical application of whatever you have learned. Today, we have the paper on taxation, and I have my great pleasure. And I would like to use the word privilege also along with that, of having with us my council colleague, Pramod Jain. There are people like Sushil Goel. He is very good in GST. Some people, they say that I am a bit adequate in corporate laws, but Pramod Jain has a very unique quality. Even though he's a vice chairman of direct tax, so you ask him questions on direct tax, he'll answer. And then when I was the chairman of corporate law and corporate governance committee, I could see that, if there is some very difficult issue on CLC, corporate laws, I would, fall back on Pramod Jain to answer them, and he will also again answer. Then, Audit and Assurance Standards Board, whenever we wanted to have good background material prepared, we would again fall back on Pramod Ji to help us out. A person who has knowledge, and not only knowledge, in-depth knowledge of direct taxes, corporate laws, audit and assurance standards, it's a rare combination. And the students who are here should take full benefit of, the address that he's going to make to us. We need more of Pramod Ji's, in our profession, because the profession basically, is, skill-based, and the more knowledge that you have, the more, important you are to your clients. With these words, I welcome Pramod Jain in our midst. Pramod Ji, thank you very much. And before I request Pramod Ji to speak, may I request Sushil Goel to speak a few words. Sushil, please.
Thank you, Pramod for coming here. And I can say that none other than you who can motivate students for the exam. Basically, in these revision classes, we also motivating students for the exams. A person who is having all three qualifications, all three professional qualifications, apart from this law graduate, have given lecture in almost 1,000 seminars, I believe, so far, and authored book not less than 25. So it is no exact number is not known to me, but I know that you have written books almost on 15 or 16 subjects. So it must be 25, cross 25 by the time. You are heading two important committees, valuation standard and the CSR. Apart from this, you are a member of the disciplinary committee. Thank you, Pramod Ji, for being here. We are looking forward for your motivation.
Thank you very much, Sushil Ji. The chairman of the Board of Studies Academics, Devashish Mitra Ji, a very learned person into audit and assurance and the corporate laws, and got so many degrees also. And I've always been looking forward to his views, and he's an excellent orator. I've heard him a few times. So excellent, Devashish sir. and Sushil Goyalji, another very dear friend. Both these luminaries are from the eastern region. One is from Guwahati, another is from the Kolkata. Though Devashish ji is again from Kolkata or the Guwahati, both. Sushil Bhai, excellent into the indirect tax, the GST. He is living into this GST arena, and this year he is working into the BOS with a great zeal. I'll just like to say that currently what Board of Studies is doing is really par excellence. These mock tests they have started, this virtual classes is being done, and I really welcome you all, friends, because when I say, first of all, it is really, I really congratulate you for choosing the career into chartered accountancy. You have cleared some of the path. You have cleared some of the path. What I say, your foundation, maybe one of the group of the intermediate, another group is pending, or even the both groups are pending. But you have started your career into chartered accountancy, a profession which is par excellence. Here, what I would like to say that some of you might be having a doubt about chartered accountancy, whether it is a tough course or the toughest course, whether it would be easy to pass or not. You know, one thing I should tell you, you have already taken a courage to just start the chartered accountancy course. Again, the zeal which you have shown to join these virtual classes early in the morning, which shows that yes, your commitment towards the learning, I would say. And of course, your learning would be helping you great in your overall career. And just I want to say that some of you are already doing your articleship and some of you would be starting it. If you really want to be successful, take these 3 years of articleship very, very serious. Why I'm saying so? It may be that some of you may not clear your chartered accountancy, but if you do your articleship very, very seriously, you are going to do wonders in your life, in your career. Just visualize a thing that when you're into articleship, who allows you to go into deep into their processes, their customers, their buyers, their sellers, how do they sell, what are their policies. You have an opportunity. You should use that. Do the articleship as if you are the owner of that. You are the owner, you are a chartered accountant. You understand their processes. Maybe after clearing your CA, or even if you don't clear, you want to be an entrepreneur and you like some of those activities which you go into. In your articleship again, suppose you are into, say, you want to go into one field, say audits, and you say today we are studying the subject of income tax. Even if you do audits, there are various portions where income tax would be applicable. Look into that. The practical approach while doing your articleship again would be, it is not that at the end of when the time that there is an exam only then you study. So when you do your articleship, whatever you do next day, prepare before night the theory portion and apply that on your practical thing. After that, there would be no worry that how I have to appear for the exam, because once you have done anything practical, then there is no looking back. Then there is no looking back. Take my words. Now, coming to income tax, when I talk about income tax, of course, we know that it is what the word says. It is a tax on income. It's a tax on income, but it is so. When I talk about income tax, we know that apart from the procedures of assessing and the other issues, the incomes are taxed under the 5 heads. 5 heads. They are income tax, that is income from salaries, income from house property, income from business and profession, income from capital gains, and whatever is left, which is not specifically given into any of these 4, is under income from other source. There is only one section under income from other source which is taxable, section 56. 57 is the deduction. Now, when I talk about 56, it again says specific incomes would be taxable. So when I talk about income tax, it is not that only incomes are taxable. Though it is income tax, even capital receipts are taxable, capital gains. Or certain heads when I talk about, even the deemed incomes are taxable, like income from house property or having 3 properties. which are not, neither of them is let out. So without even earning, you have to pay tax. Or say in section 56(2)(10), there could be another deemed income. There could be another deemed income. Suppose a friend has gifted you, a jewelry worth rupees 1 lakh. That you have not earned anything, but that is a deemed income in your hands, exceeding rupees 50,000. So when you see that, when you read income tax, apart from the study material of the institute, I'll request you to read the Bare Act. When you, even in the Bare Act, if you go to the content section, you'll see it is not only for income tax, I'll say for any law. If you go to the content section, you'll understand the whole schema of the act. You'll understand the whole schema of the act, and you will be able to correlate it. So apart from the study material of the institute, these revisional classes, purchase a Bare Act. Purchase a Bare Act. This is what we were taught when I was in college, Shriram College of Commerce. That read through the Bare Act, not by any commentary or this thing. So when you are reading by the Bare Act, if there is any doubt, then go to commentary. I am telling you, whosoever is going to do that would do wonders in their life. You just try that. A very, very happy learning, I would say, because if you are happy while learning, there will be no looking back. My all the best for your future career and these revision classes. All the best for this. Thank you very much.
Pramodji, thank you very much for sharing with your thoughts with us. And you see, students, the last part of his speech, enjoy your learning. That is very, very important. If you enjoy, I think you will have no obstacles in passing the CA course. And of course, do not forget to note the depth of his learning. So you see, if you have a full grasp over your subject and enjoy the subject, then you are certainly going to pass the CA exam. Pramodji, thank you very much for your kind presence here. So it is over to the designated speaker. Thank you very much, Pramodji.
Thank you. Thank you. Thank you.
Good morning, students. Good morning, students. I welcome you to this session on income tax. Today, I'll be taking you through the significant provisions of two heads of income, income from house property and profits and gains of business or profession. Before I begin, let me tell you about the applicability for the forthcoming examination. I'm sure all of you must be aware, but just I'm telling you once again so that you have clarity in this matter. The income tax law as amended by the Finance Act 2019 and Finance Number 2 Act 2019, as well as notifications, circulars issued up to 31st October 2019. Now, the study material, the August 19 edition of the study material is your relevant study material. Contains the law provisions of income tax as amended by the Finance Act 19 and the Finance Number 2 Act 19, as well as circulars, notifications, and the latest circulars and notifications. The circulars and notifications after the date of the study material and up to 31st October 2019, which is the cutoff date for the forthcoming examination, is given in the statutory update and it's web hosted at the BOS Knowledge Portal. It also forms part of the RTP. So the statutory update has to be read along with the August 19 edition of the study material. Now I will proceed to talk on income from house property. So any income which is taxable under the provisions of the Income Tax Act are grouped and have to fall under one of the 5 heads of income. They are salaries, income from house property, profits and gains of business and profession, capital gains, and income from other sources. So salaries is only for individual, and the other 4 heads of income are for other assets, all other assets. Individuals can also have other 4 heads of income. Now, what is there? What to tax under each head of income? What is brought to tax? Which are the income which is brought to tax under each head of income? How do you go about computing the income? What are the deductions you provide? all these are contained under the respective head of income. So each head of income has a charging section which spells out what is the income which is chargeable to tax under that head. Salaries, the charging section is 15. For income and from house property, it's 22. For profits and gains of business and profession, it is 28. For capital gains, it's 45. And for income from other sources, it is 56. So these are the 5 heads of income, and the charging sections for each head spells out what is the income which is taxable under that, chargeable to tax under that particular head of income. So apart from charging provisions, some heads of income also have deeming provisions which bring to tax certain income under that particular head. For example, under the head profits and gains of business and profession, section 41 is a deeming provision which brings to tax income under that head. In addition to the charging provision, section 28, there's a deeming provision, section 41. In addition, as the word income specifies, it is the income which is chargeable to tax under the income tax act. So every head of income necessarily provides for certain deductions while computing the income. Some may be standard deduction, like in the case of salary, section 60 provides for standard deduction. In the case of house property, section 24A provides for a standard deduction. But most of the other deductions are specific deductions for which you have to comply with certain conditions. If those conditions are complied with, you become eligible for those deductions. So every head of income contains certain provisions for deductions. For example, in case of salary, section 16 provides for standard deduction, professional tax and entertainment allowance. Section 24, in the case of income from house property, it provides for standard deduction of 30% of net annual value and interest deduction. For profits and gains and of business and profession, it's 30 to 37 provides for deduction, and so on. Some heads of income also spell out certain deductions. They expressly state that certain deductions are not allowable. Like in the case of profits and gains of business and profession, section 40 clearly spells out that deductions which are not available. Likewise, in the case of income from other sources, section 58 spells out what is not allowable. Clearly state that this expenditure is not allowable while computing income under the head, so that there's no confusion. There's no confusion as regards the allowability of such. Apart from these, there are certain miscellaneous provisions also. Like for example, under the head profits and gains of business and profession, you have presumptive tax provisions. You have tax audit, provisions for tax audit, provisions for maintenance of books of accounts. These are the other provisions. Every head of income necessarily has charging provisions and deductions. So now I will take you to the head of income. Two heads of income which we will be dealing with today are income from house property and profits and gains of business of profession. I'll be sharing the slide with you right now. Hope the slide is visible. Now coming to income from house property. Charging section, as I told you, is section 22. Now, what is income from house property? In a common parlance, what would anybody perceive income from house property to? The actual rent which I'm getting from my tenant, the rent which the tenant pays me is my actual rent. And in common parlance, that is taken to be the income from house property. But what does section 22 say? Section 22 talks about annual value of house property. Under section 22, it's the annual value of house property which is chargeable to tax. Now, is annual value same as the actual rent? Not necessarily. It is one of the factors which determines the actual rent is one of the factors which determine the annual value. But it's not the only factor. There is yet another factor called the expected rent. How to determine annual value, that I will come to when I come to section 23. Now when I talk about the charging section, first it is the annual value of a house property which is chargeable to tax. And two factors which govern the annual value are the expected rent and actual rent. And what is the annual value of what? Annual value of what? Which is any property comprising of buildings or land appertaining thereto. Buildings or land appertaining thereto. It is not only land. There has to be a building and land appertaining thereto, or land appertaining thereto. Land appertaining thereto may be a garden, garage, anything of that sort, of which the assessee is the owner. The assessee has to be the owner of the building. Another criterion which is laid down in the charging section. So the charging section spells out that it's the annual value of house property should be chargeable to tax. Property should comprise of buildings or land appertaining thereto. The assessee should be the owner of such building. Can't be a tenant. So I can't be a tenant. Then I sublet my property. That subletting the receipt won't be taxable under the head income from house, because the tenant is not the owner of the house property. So the condition that he should be the owner is very essential for income to be chargeable under this one. And the charging provision also contains an exclusion. What is excluded from the scope of this section? It is a house property which I am going to occupy for the purpose of my own business or profession, profits of which are chargeable to tax under the income. Suppose I am occupying carrying on my own profession of chartered accountants. Then the annual value of such house property will not be chargeable to tax under the head income from. This is contained in the charging section itself. This is an exclusion. Now let us go through all the components of charging section, section 22. As far as the annual value of the property which is chargeable to tax, that we will take it up in section 23 when I come to section 23. The other components, the property should comprise of buildings or land appertaining thereto. A building, it is not necessary that it should be a residential building. It can even be a commercial building. It can be a shop. Here again, if I income from that shop will be chargeable under the head income from house. But as I said, income from letting out of vacant land is not chargeable to tax under income from house property. It is chargeable to tax under profits and the gain of business or profession, or it will be chargeable to tax under the head income from other sources. Then the assessee must be the owner of the property. Who is the owner? Owner is the person who is entitled to receive the income from property in his own right. So actually, requirement of registration of sale deed is not warranted. Even without the sale deed, if he transfers if I am enjoying the property, if I got possession of sale deed is executed, I paid the entire consideration, or I promised to pay the consideration, and I satisfy all the conditions under the Transfer of Property Act, part performance of a contract, then again also I am the owner. So exactly the sale deed may not be required. I might have a power of attorney. That will also, I become the owner in such a case also. And ownership includes both freehold and leasehold rights. Like for example, if I purchase a property in Ghaziabad, I might not always get freehold rights in the property. It might be a 99-year-old lease. Even then, I am the owner of the property. Freehold ownership is also falls within the definition of ownership. It's necessary that the person should be the owner of the building. He may not necessarily be the owner of the land on which the building stands. What is important is when should the ownership be? Now, right now we are talking about assessment year 2021. The previous year is 2019-20. The assessee has to be the owner of the house property in the previous year 2019-20. Post March 2020, I am going to sell my property. It is okay. But for the previous year 1920, the income from the property will be chargeable to tax under the head income from house property. So ownership in the previous year is what is relevant. Then ownership includes deemed ownership. Here again the deeming provisions come into play. What is deemed ownership? Section 27 spells out circumstances when a person, even though he may not be the actual owner of the house property, him to be the owner of the house property, the income from house property will be chargeable to tax in his hand. What are the cases? Like if I transfer my property to my spouse or to my minor child, I am deemed to be the owner of the property. Though they might be in receipt of the rent from the property because they are the actual owner, since I am deemed to be the owner, the income would be chargeable to tax in my hands. If I'm transferring to my spouse or my minor child for inadequate consideration. If the consideration is adequate, then the deeming provisions won't be applied. If I'm transferring for inadequate consideration, then I am deemed to be the owner of the house property which I'm transferring to my spouse or which I'm transferring to my minor child. There are certain exceptions to it. If Mr. X is transferring to Mrs. X in consideration for an agreement to live apart, then Mr. X will not be deemed to be the owner of the house property which is so transferred in consideration for an agreement to live apart. Likewise, if Mr. X is transferring to his minor married daughter, there again he won't be deemed to be the owner of the house property. So these are the two exceptions where Mr. X won't be deemed to be the owner of the house property even though the transfer may be for inadequate consideration. Also, what happens if I'm going to transfer money to my spouse or to my minor child and they purchase a building property with that money? In that case, I would not be deemed to be the owner. What I'm transferring is not building. I'm just transferring the cash to them and they are purchasing the building. So I won't be the deemed owner under 27. Although clubbing provisions under section 64 may be attracted, clubbing provisions will be dealt with tomorrow. And then a member of a cooperative society, company or other association of persons to whom a flat has been allotted under a house building scheme. So the member will be deemed to be the owner of that flat which has been so allotted to him. Then person in possession of property not registered in his name. This is the Transfer of Property Act which I told you about just now. That the sale deed is not executed, but I am in possession of the property. The possession of the property has been transferred to me. And I have paid the consideration or I have promised to pay the consideration. Payment for sale has been executed. So all these conditions are satisfied. So even though the property may not be actually registered in my name, I still am the deemed owner of the property and income from that property will be chargeable to tax in my hands. The person having a right in a property for a period not less than 12 years. So if I have a right in a property for a period not less than 12 years, even then I am the deemed owner. But this does not include rights by way of a lease from month to month basis or for a period not exceeding 1 year. That kind of lease is not included. Then I am not a deemed owner if it's a lease by way of a month to month basis or for a period not exceeding. So these are the cases of deemed ownership where the person who is the deemed owner will be the owner, treated as the owner for the purpose of charge of income tax under the head income from house property. Now, the exclusion clause, as I said in the beginning, any property which I occupy for the purpose of my own business or profession, the profits of which are chargeable to tax under the Income Tax Act, will not be chargeable to the annual value of such property will not be chargeable to tax under the head income from house property. This contained in the charging section, section 22. In addition, suppose there is a company whose main business is to let out properties. The business of the company is to let out properties. Then the income from letting out of such properties will be chargeable to tax under the head profits and gains of business and profession and not under the head income from house. This is not there in the charging section, but it is decided through case laws. I will not go into what are the case laws because that is not relevant for you at the intermediate level. But this much you have to remember, if a company or an organization is engaged in the business of letting out of, then the income from such properties will be chargeable to the head profits and gains of profession. And what about a property which I hold as my stock in trade? So what is a stock in trade? Let us say I am a developer of a building. I construct buildings and then I sell the buildings. But there will be some gap between the time I complete my construction and I am able to sell the building. I am able to find a buyer for the building and I sell at some gap. During that gap, I hold the buildings as my stock in trade. The annual value of such buildings is chargeable to tax under the head income from house property. So, but however, I get an exemption for a period of 2 years from the end of the financial year in which the construction was completed. Like suppose the certificate of completion of construction I am obtaining now in this month. May 2019, I'm getting the certificate of completion of house property. But I'm not able to sell the property, so I'm holding it. My real estate market is not good. I'm not able to sell it quickly. I'm holding it as my stock in trade. I'm not getting any further benefits in that property. Not renting it out or anything like that. Then, what is the end of the previous year? The end of the previous year is 31/3/2021. Because I'm getting my property is completed only this month, so the end of the previous year is 31/3/21. 2 years from the end of the previous year is 31/3/2023. Till that time, my annual value of my house property will be nil. What does that mean? If the annual value is nil, it is not chargeable to tax. That is, it's a nil value which is charged, so I won't have any income tax under the head income from house property. So that is the treatment of stock in trade. What happens after 2023? After 2023, it will be treated as a deemed let out property, even though I'm actually not letting it out, and the annual value will be chargeable to tax under the head income from house property. So this is the difference. I hope you understand the difference between a person engaged in the business of letting out a property. If suppose I have my occupation is to let out properties, giving properties on rent, then that income is chargeable to tax under the head profits and gains of business or profession. But suppose I'm a developer of properties and I hold the property as stock and trade for sale of property, and I'm ultimately my business is to sell the properties, then the annual value of such property will be chargeable to tax under the head income from house property. However, for 2 years from the end of the financial year of completion of construction, the annual value would be nil. That's a benefit which has been given for holding my house property as a stock in trade. After the end of the 2-year period, it will be the annual value will be chargeable to tax under the head income from house property if I still continue to hold the property stock in trade. Now we come to annual value. All this while we've been talking about annual value, which is the charging section talks about the annual value, which is chargeable to tax under the head income from house property. So what is this annual value? So now I take a situation of a house property which is let out throughout the previous year. Let out means I give it on rent. In simple language, it's giving it on rent throughout the previous year. How do I proceed to compute the annual value of property? There are two aspects in case of a let out for determining the annual value. One is the actual rent, that is what I get from my actual rent received or receivable from my tenant, and the other is the expected rent. What is expected rent? Expected rent consists of, you have 3 factors which have to be taken into consideration to determine expected rent. They are the municipal value, fair rent, and standard rent. Municipal value is the value which is fixed by the municipal authorities for levy of municipal tax. That's the municipal value. Fair rent is a rent which a similar property in the same locality would fetch. Standard rent is the rent which is fixed under the Rent Control Act. Some states are governed by the Rent Control Act like Delhi, Tamil Nadu. Some states in India are governed by the Rent Control Act, and there's a standard rent which is fixed under the Rent Control Act. The expected rent can never exceed the standard rent. It can be lower than the standard rent, but expected rent can't exceed the standard rent. So, how do you compute the expected rent? The first 2 factors, it's a higher of municipal value and fair rent. To arrive at a particular figure, let me take you to the chart. It will be easier for you to understand. Now compare step 1. Compare fair rent and municipal value, whichever is higher. Let us say fair rent is 1,20,000. Municipal value is 1,50,000. The higher of the two is 1,50,000. That's the step 1 value. Step 2 is I compare the step 1 value with standard. Step 1 value is 1,50,000. Standard rent, let us say if the standard rent is 1 lakh, then you have to see whichever is lower. Whichever is lower. So 1,50,000 or 1 lakh, whichever is lower is the expected rent. So 1 lakh is lower, that would be the expected rent. And your standard rent being 1,60,000, then expected rent would be 1,60,000 or 1,50,000, which is the step 1 value, whichever is lower. In that case, it will be 1,50,000. So it depends upon what your standard rent is. So first you do compare fair rent with municipal value, whichever is higher. We know it's 1,50,000. Compare 1,50,000 with standard rent. Let us assume it to be 1 lakh. So 1,50,000 and 1 lakh, whichever is lower is 1 lakh, which is your expected rent. Now we've got one of the factors, expected rent. What is the other factor? The other factor is your actual rent. So rent, let us take, it's 10,000 per month. So your rent for the whole year will be 1,20,000. So compare expected rent 1 lakh with actual rent 1,20,000. So in this case, actual rent is greater than the expected rent. So actual rent is the gross annual value. What happens if the actual rent is lower than the expected rent? When will the actual rent be lower than the expected rent? Now suppose the actual rent is lower than the expected rent because of vacancy. Now I've told you that 10,000, let us assume a figure of 10,000 as your monthly rent. Your annual rent is 1,20,000, which is higher than the expected rent of 1 lakh. Suppose my house property is vacant for 3 months. I've let it out only up to December. Jan, Feb and March, it is vacant. So what will my rent be? 10,000 into 9, 90,000. So my actual rent will become lower than my expected rent. See, expected rent I don't reduce proportionately. It's always for the full year. So expected rent is 1 lakh. But my actual rent is only 90,000. So in this case, what happens? My actual rent is lower than my expected rent owing to vacancy. So that is the only exception where the lower figure of actual rent will be the gross annual value. Otherwise, normally it's the higher of actual rent than expected rent. But however, the actual rent is lower than the expected rent owing to vacancy, then the Act gives us the benefit of taking the lower figure of actual rent as the gross annual. But what if the actual rent is lower than expected rent because of any other reason? Suppose April to December I let out my property for 10,000 per month. After that I self-occupy my property. I occupy the property on my own. Then what? Then in that case also my actual rent is 90,000, my expected rent is 1 lakh. So, but in that case I don't get the benefit of lower because my actual rent is lower. Because the actual rent is not lower because of vacancy. Because of some other reasons. In this case it's because of self-occupation. That case only the higher figure will be the gross annual rent. Gross annual value. That is the expected rent of 1 lakh will be the gross annual value. I hope this is very clear. So first, two figures have to be compared, expected rent and the actual rent. Whichever is higher is the gross annual value. Then how do I determine the expected rent? Expected rent is the higher of municipal value and fair rent. So that will be the step 1 value. Then I compare with standard rent and take the lower of the two figures. That will be my expected rent. Then I compare expected rent to the actual rent, and higher of the two figures would be my gross annual value, except in the case where actual rent is lower than the expected rent owing to vacancy. That case alone, the actual rent would be the gross annual value. If the actual rent is lower than the expected rent owing to any other reason, then it's the expected rent which will be the gross annual value. So actually, initially, when you're studying, it might be confusing because at the initial instance, you take the higher figure of fair and municipal value. Thereafter, you take that figure and standard rent, whichever is lower, you get the expected rent. Then to arrive at the gross annual value, you take the higher of expected rent and actual rent. So once you start working out some problems, you will get clarity on this. Just see, read this particular chart. It's forming part of your study material also. You will get clarity once you read the chart and work out a few illustrations. Now, what is unrealized rent? Suppose in the example which I gave you, 10 months, the 10,000 per month is the actual rent. But suppose I'm not able to realize the rent from my tenant for month of March. I'm not able to realize, he doesn't have money to pay me. He's not able to pay me. And the tenancy is bona fide, and provided I satisfy all the conditions prescribed in Rule 4. That is, the defaulting tenancy is being vacated. After that, I've asked him to leave the property. He doesn't occupy any other property of my own. If all my conditions are fulfilled, then the 10,000 which I'm not able to realize has to be reduced from my actual rent. 10,000, like if 1,20,000 is my actual rent now, 10,000 into 12, because rent for the month of March I'm not able to realize. So my actual rent becomes 1,10,000. So I have to compare 1,10,000 and expected rent of 1 lakh. Whichever is higher will be my gross annual value. 1,10,000 and 1 lakh, the higher figure is 1,10,000, will be my gross annual value. Then let's take a small illustration to explain this. Jayashree owns 3 houses in India, all of which are let out. Compute the gross annual value of each house from the information given below. So house 1, let me share the home screen. House 1, the municipal value is given as 80,000, fair rent is 90,000. Standard rent is not applicable and actual rent is 72,000. Now what do we say for house rent? In this case, the higher of municipal value and fair rent, so it is 90,000. This is the step 1 value. Then there is no standard rent, so the 90,000 is the expected rent. I compare it with 72,000 actual rent. So higher of the two figures is 90,000, so that will be the gross annual value of my property. House 2, the municipal value is 55,000, fair rent is 60,000. Higher of the two is my step 1 value, 60,000. Then I compare it with standard rent of 75,000, whichever is lower will be my expected rent. So expected rent is 60,000. Actual rent here again is 72,000. So higher of actual rent and expected rent will be the gross annual value, which is 72,000. Similarly, house 3, municipal value and fair rent are the same. So 65,000 is the step 1 value. I compare it with standard rent, which is 58,000. So expected rent is the lower of 65,000 and 58,000. So it's 58,000. But gross annual value is the higher of actual rent and expected rent, which is 60,000. So you can see how to go about comparing the figures to arrive at the gross annual value. This is a case where the house property has been let out throughout the previous year. There is no vacancy, there is no unrealized rent. This illustration is that kind of an illustration. That's why we are able to do a direct comparison. Now 23.2 talks about an annual value of self-occupied property. What we first saw in the chart was a let out property. In case of a self-occupied property, strictly speaking, I'm not getting any benefit out of that. I'm not getting any rental income out of it. So the Act gives a benefit of nil annual value in respect of self-occupied property. It can either be a self-occupied property or a property which I'm not able to occupy during the previous year owing to my employment, business or profession being carried out at some other place. And I'm residing at that other place in a building which is not owned by me. In such a case, the annual value of this unoccupied property will be nil, provided I don't derive any other benefit from the property. Now, the assessee can claim the benefit of nil annual value in respect of a maximum of 2 residential house properties. I can claim nil annual value. That means it is not chargeable to tax. What happened if the house property is part of the year let out and part of the year self-occupied? I have already told you how to deal with it. The expected rent in such a case, it will be treated as a let out property. You won't get any benefit of self-occupation. If it's let out, if you're a self-occupying only for part of the year. Only if you self-occupy for the whole year, you get benefit of self-occupation. So self-occupied for part of the year and let out for the remaining part of the year will be treated as a let out property. What you do is you compare the expected rent for the whole year with the actual rent. Actual rent will be only for the let out period. Suppose in our above example, I let it out for 10,000 per month for the period from April to December. And then thereafter I self-occupy it. My actual rent will be for 9 months only, 90,000. But my expected rent 1 lakh is for the whole year. So those are the two figures which I have to compare. I don't reduce expected rent proportionally. Expected rent is for the full year and actual rent is for the let out period. I compare the two, whichever is higher will be my annual value. Municipal tax will be allowed as a deduction. Municipal tax which is paid by the owner during the previous year will be allowed as deduction while computing my gross annual value, and that will be allowed in full. Provided it's paid by the owner. If it's paid by the tenant, it's not allowable, and if it's due but not paid, there again it's not allowable. In case of a house property, a portion let out and a portion self-occupied. Suppose I own a house property, it has 3 floors. 1 floor I am occupying for myself and 2 floors I have let it out. Then there are 2 units. In effect, there are 2 units in my house property. 1 unit is 1/3 portion which I am occupying for my self-occupation. 2/3 portion I am letting it out. For that 2/3 portion, you do the computation separately, applying the rules for let out property. For that 1/3 portion, you take the annual value of nil as nil and do the computation accordingly. Now, what happens? Like, suppose the expected rent figures for municipal value, standard rent, and fair rent are given for the whole year. Then you have to do 2/3 of that figure. Thereafter, suppose its expected rent comes to 3 lakh for the whole building. Then I have to take 2/3 of 3 lakh, which is 2 lakh. Then I compare that with my actual rent. Actual rent, I need not do any adjustment. That is definitely only for the let out portion. Take the actual rent, compare expected rent of 2 lakh with the actual rent. Whichever is higher will be my gross annual value. From that, municipal taxes, which I am paying as the owner, I am actually paying during the relevant previous year as the owner of the property, that I will be entitled to deduction. Municipal property, actually, if that also is given for the whole building, then you have to do 2/3 of that also. 1/3 will be for the let out portion, for which, self-occupied portion, for which no deduction will be given. 2/3 portion of the municipal taxes I can claim. Suppose the municipal taxes is 30,000. Then 20,000 I can claim as deduction while computing my income from house property, because 2/3 portion only has been let out. 1/3 is self-occupied, for which municipal taxes is not allowable as deduction. Annual value of deemed to be let out property. What is deemed to be let out? As the name denotes, it's not actually let out. It's simply deemed to be let out. Why? Suppose I have more than 2 properties, self-occupation. I can enjoy the benefit of self-occupation only for a maximum of 2 properties. That is my choice, which I choose out of the 3, which is more beneficial to me. I choose that. Then the 3rd property will be deemed to be let out property, even though I have actually not let it out. So that will be chargeable to tax. Annual value of that property will be chargeable to tax under the head income from house property. How do you go about? What is the annual value? I'm not let it out, so I'm not getting any rent in respect of that property. Only my expected rent. My expected rent will be the annual value of a deemed let out property. Higher of municipal value and fair rent restricted to standard rent. In this case also, since annual value is chargeable to tax, municipal taxes paid by the owner is fully allowable as deduction. In 23.5, I've already talked about it. Annual value of a property which I hold as my stock. Up to a period of 2 years from the end of the financial year in which certificate of construction is obtained from the competent authority, the annual value will be nil. Thereafter, my expected rent will be the annual value. This is how I go about determining the annual value. Now, from the gross annual value, municipal taxes paid by the owner during the relevant previous year would be allowed as a deduction. In case of let out and deemed let out property, in case of self-occupied property, municipal taxes is not allowed as deduction. That's why when there is a portion self-occupied, portion let out, 2/3 portion let out, 1/3 portion self-occupied, only the 2/3 of the municipal taxes paid will be allowed as a deduction. If it's paid by the tenant, it's not allowed as a deduction. If it's due but not paid also, it's not allowed as a deduction. However, if I'm paying arrears of the last year's municipal taxes in the current year, then current year, since I'm paying those municipal taxes, it's allowed as a deduction. So it's basically allowed as a deduction on payment basis, and payment has to be by the owner himself. Now, the resultant figure is the net annual value. And from the net annual value, so I arrive at the gross annual value, I deduct municipal taxes, the resultant figure is the net annual value. From the net annual value, I'm eligible for 2 deductions. In case of a let out property, here I'm talking about a let out and deemed to be let out property. 30% of net annual value, I'm eligible as deduction, whatever figure. The expected rent minus municipal taxes paid. Suppose my net annual value comes to 1 lakh. 30% of 1 lakh 30,000 is the standard deduction under 24A, which all let out properties and deemed to be let out properties are eligible to. Second deduction is the interest on borrowed capital. I borrowed money for acquiring the house property, constructing the house property, reconstructing house property, for repairing the house property. This which I am paying is fully allowable as deduction of let out and deemed to be let out. Not only in case of construction, suppose I have taken a loan on 1/4/2017. My property is completed, the construction is completed on 36/2019, this previous year. Then, pre-construction interest, also one portion, 1/5 of the pre-construction interest is also allowable as deduction. What is pre-construction interest? Is it up to 1417 to 36 2019? No, it's not up to 36 2019. Whatever interest I am getting eligible for in the current previous year, 1920, the year in which construction is completed, I am eligible for full in that year. Pre-construction interest is for the period up to the end of the earlier previous year. That is up to 31/3/2019 in the example which I gave you. My construction is completed on 36/2019. The interest which accrues up to 31/3/2019 is the pre-construction interest from 1/4/17 to 31/3/19. Let us say I take a loan of 20 lakh for construction of property. And the interest is 10%. Okay? Now, what is the annual interest? 10% of 20 lakhs, 2 lakhs. For 2 years, this is the pre-construction period. 2 lakh into 2, it's 4 lakh. 4 lakh is the pre-construction interest, which I'm eligible to claim over a period of 5 years. So 4 lakh divided by 5 is 80,000, which I can claim in the next 5 years starting from the previous year, 1920. In addition to the interest which is accruing in that year, the previous year, 1920 also, I have to pay interest of 2 lakh, 10% of 20 lakh, 2 lakh. That plus the pre-construction, 1/5 of the pre-construction interest, 80,000, 2 lakh 80,000 I am eligible for deduction under section 24B. That's the total interest in case of a let out or deemed to be let out. But what about in case of a self-occupied property? In self-occupied property, my annual value is nil. I can't claim municipal taxes as deduction. So, standard deduction under 24A is not allowable. What about interest? Am I eligible for interest? Yes, I am eligible for interest, but it is subject to certain limits. Suppose, in case I borrowed the loan before 1/4/99, then whatever purpose I might borrow it for, whether it's for acquisition, construction, reconstruction, repairs or renewal, the maximum deduction which is allowable for interest paid is 30,000. Full interest of 30,000, whichever is lower. Suppose I borrow the loan on or after 1/4/1999. And I'm using, it is for the purpose of acquisition or construction. Plus, one more condition has to be satisfied, that the property construction of the property is completed within 5 years from the end of the year in which the loan is taken. This condition is also satisfied. Then I get a higher deduction of up to 2 lakh. Actual interest paid or 2 lakh, whichever is higher. 2 lakh is the maximum interest which I'll be eligible for deduction, provided the construction is completed within 5 years from the end of the financial year which loan was taken, and I get a certificate from the lender stating that this is the interest payable. Even if I borrow the loan on or after 1/4/99, but I borrowed it for the purpose of repairs, reconstruction or renewal, then I am not entitled to higher deduction of 2 lakh, I am entitled to only deduction of 30,000. So these are the things for, but here these restrictions apply only for self-occupied property. They are not applicable for let-out property or deemed let-out property. For deemed let-out and let-out property, this deduction is allowable in full. This limits which I am talking about is only in case of self-occupied property for which I have taken nil annual value. So it's an additional benefit which the income tax is giving me. Actually, if you claim that loss, deduction in respect of self-occupied property, what will be the result? The result will be a loss from house property. Up to 30,000 in case of interest on loan taken for repairs and all, and in case of acquisition and construction fulfilling the condition, it's up to 2 lakh. Now this chart will tell one more thing which I want to say is 2 lakh figure is the maximum figure for both the house properties put together, because you can claim benefit of self-occupation for 2 house properties. But I am not eligible for 2 lakh separately for each of the house properties. Total amount of interest, aggregate interest deduction under section 24B for self-occupied property or properties cannot exceed 2 lakh. In case it's borrowed for repairs and all, it cannot exceed 30,000. This chart will give a clearer picture. Deductions allowed from net annual value. In case of let out or deemed to be let out property, 2 deductions. Standard deduction under section 24A, 30% of net annual value. Then interest on borrowed capital, fully allowed. Here, whatever may be the figure, it's fully allowed. Whether it's for repairs, renewal, reconstruction, whatever it is, it's fully allowed in case of a let out and deemed to be let out. What about a self-occupied property? Interest where the loan is taken for repair, renewal or reconstruction. Maximum 30,000 for one or two self-occupied properties as the case may be, but maximum is only 30,000. A loan is taken for acquisition or construction of a house property. Loan is taken before 1499. Again, its maximum is 30,000 deduction. If loan is taken on or after 1499, so step 1 is compute the expected rent. So in this case, what is the figures which we have to consider expected rent period? Municipal value is 3 lakh, fair rent is 2 lakh 70,000, standard rent is 3 lakh 30,000. You have to take 1/3 of these three values because only 1/3 portion is left out. So it's higher of municipal value of 1 lakh and fair rent of 90,000, that is 1 lakh. And compare it with standard rent of 1 lakh 10,000. Lower of the two figures is 1 lakh. So 1 lakh will be the expected rent and the actual rent is 8,000 into 12, which is 96,000. So it's higher of expected rent of 1 lakh, which is 1/3 of 3 lakh, and actual rent of 96,000. So the higher figure is 1 lakh, which is the gross annual value. Municipal tax paid by the owner is 10% of municipal value, 10% of 3 lakh, 30,000. But 30,000 is for the whole property. So you have to do 1/3. Only 1/3 of the property is let out. So 1/3 of 30,000 will be 10,000. So 10,000 will be reduced from the gross annual value of 1 lakh. So the net annual value will be 90,000. What are the deductions? Standard deduction I'm entitled to 30% of 90,000, which is 27,000. And interest and borrowed capital, 1/3 of 1,20,000. So 40,000. So both the reductions I'm entitled here, 30% of net annual value 27,000 as well as 1/3 of 1,20,000, 40,000, which totals 67,000. So income from unit 2 will be 90,000 minus 67,000, 23,000. So loss from unit 1 on account of interest, 80,000, because it's self-occupied property portion, 2/3 is self-occupied, annual value is nil, only deduction is interest deduction, which is 2/3 of 1,20,000, it's 80,000. So 80,000 is loss from self-occupied portion. Income from let out portion is 23,000. The net loss from income from house property is 23,000 minus 80,000, 57. What are the inadmissible deductions? Inadmissible deductions under the head income from house property is a case where the interest deduction which you are getting under section 24, suppose I have to pay that interest at borrowed from outside India, then there is a requirement that I have to deduct tax at source. Then, and if I have not deducted the tax at source, and there's no person in India who can be treated as the agent of that non-resident, in that case, the interest won't be allowed as a deduction. So it's only in a case where interest is payable outside India and tax has not been deducted. 25A. 25A talks about arrears of rent and unrealized. What is unrealized rent? Unrealized rent we've already seen earlier. I talked about a case that my tenant is not able to pay me the money. On the rent for the month of March, he was not able to pay me. Didn't have the money, he has some problems, he's not able to pay me, and I've asked him to leave the house, vacate the house. So that is unrealized rent. But now he's a genuine person. After some years, when he got the money, he's decided now to pay me that money. So I've received unrealized rent after 3-4 years. He comes back and pays me the money. But in the meanwhile, I've sold my property also. I'm no longer the owner of property. Likewise, suppose the 10,000, the rent which was 10,000 in my property, I increased it to 12,000. But my tenant has some disputes. He's not agreeing with the increased rent. So he continues to pay me only 10,000. The dispute is going on. Dispute finally got settled, and now I'm getting that arrears of rent. 2,000 difference, 2,000 into 12, 24,000. Now I'm getting it. But in the meanwhile, I've sold the property. All these were for the assessment year 2017, 18, and 18, 19. During the year, previous year, 18, 19, I've sold the property also. No longer the owner of the property. But in the charging section, we have seen that you have to be the owner of the property for income to be chargeable under this head. So what will happen to the arrears of rent and unrealized rent which I'm recovering now? Here, this is one exception. That even though I'm not the owner of the property in the relevant previous year 1920, I may or may not be the owner of the property. Still, if I get recover some unrealized rent, or if I get arrears of rent, they will be chargeable to tax under section 25A under the head income from house after providing 30% deduction. Suppose I get the 10,000 rupees, I deduct 3,000, 30% deduction, and 7,000 will be chargeable to tax. Arrears of rent 2,000 into 12, 24,000 I get, minus 30% of that, the balance will be chargeable to tax under 25A, even if I am not the owner of the house. What is co-owned property? 26 talks about co-owned property. What is co-owned property? I, along with my sister, we together own a property. I have 60% share, my sister has 40% share in the property. Now, how will I compute that property? It's only one property. How do I compute the income from that property? So, the treatment is different if it's a let-out and if it's a self-occupied. If it's a let-out property, you continue to treat it as a single property. Do the computation. Like what rules have been laid down so far, do the computation. Finally, you will arrive at the income from house property. Let us say the income is 10 lakh. Then 60%. I have 60% share in the property, so 6 lakh will be chargeable to tax in my hand. 4 lakh will be chargeable to tax in my sister's. What I do, I make a normal single computation for that income from co-owned property. The net resultant figure, 60% would be chargeable to tax in my hands, 40% would be chargeable to tax in my sister's. So it's as simple as that. What if both of us are self-occupying the property? Both of us are self-occupying the property, and the annual value is nil. And both me and my sister will be individually entitled to the interest benefit of 2 lakh. Individually. I will be separately entitled for 2 lakh. My sister will be separately entitled for 2 lakh. So that is individual. And if it's for repairs, it's 30,000 each, as the case may be. But it's individual. It's not a combined amount. That's what. But what if I have a co-owned property along with my sister, and I separately own another property also? Or which again is, I'm treating it as my self-occupied property because I'm allowed to treat 2 properties as my self-occupied property. Unless my co-owned property, others my individual property. There again, on my individual property plus my co-owned property, my total interest deduction cannot exceed 2 lakh. Not 2 lakh for each property, it's 2 lakh for the assessee as a whole. I have a small example in this. Aparna co-owns a residential house property in Calcutta along with her sister Dimple, where her sister's family resides. Dimple's family resides there. Both of them have equal share in the property and the same is used by them for self-occupation. Interest is payable in respect of loan of 50 lakh at 10% taken on 1/4/2018 for acquisition of that property. In addition, Aparna also owns another flat in Pune, which she and her parents reside. He has taken a loan of 3 lakh at 12% on 1/10/2018 for repairs of this flat. She owns a property, co-owns a property with Dimple, who is a sister. Dimple's family is occupying it. that she owns in Calcutta. Apart from that, she owns another flat in Pune where she and her parents reside. And she's taken a loan for repairs of that flat. Now, what is the deduction which would be available to Aparna and Dimple under 24B for assessment year 2021? Now, it's a self-occupied property for both Aparna and Dimple. Now, what would Aparna be entitled for? For the Calcutta property, what is the interest? 50 lakh into 10%. 5 lakh is the total interest. Okay? And Aparna's share is 50%. So it will be 2,50,000. But it will be restricted to 2 lakh, which is the maximum interest allowable in her hands. Restricted to 2 lakh. Now she has, in addition, she's also taken loan for repair of a flat in Pune. The 3 lakh she's taken at 12%. So that comes to 36,000. That again has to be restricted to 30,000 because it's for repairs. So that for that flat she'll be entitled to 30,000. Totally it's 2,30,000. But deduction under 24B is for Aparna, not for individual house property. So totally for Aparna, she will be entitled to a maximum deduction of only 2 lakh. Though individually she is entitled to a deduction of 2,30,000, but the total deduction under 24B in Aparna's case will be restricted to 2 lakh. What about Dimple now? Dimple, she again 10% of 50 lakhs is 5 lakh. Dimple's share is again 50%. Her share is 2,50,000. Here again it will be restricted to 2 lakh. In her case, she would be entitled to a deduction of 2 lakh under Section 24B. What about an income from house property which is situated outside India? So how do you deal with a house property which is situated outside India? In case of a resident in India, person who is a resident and ordinarily resident, in case of individuals and HUF, the income from house property situated outside India is taxable. Whether such income is brought into India or not, if I have a house property in UK, USA, and if I am resident in India and resident and ordinarily resident in case of individuals and income from that property will be chargeable to tax in India. It is chargeable to tax and municipal tax which I pay there, I am eligible for deduction in respect of that municipal tax. But if I am a non-resident but a resident or a resident but not ordinarily resident in India, income from property situated outside India would be taxable in my hands only if it is received in India. In case of if I am a non-resident or a resident but not ordinarily resident. Right? Income from property outside India will be taxable in my hands only if it is received in India. If I am going to receive it outside India, it won't be chargeable to tax in my hand. So these are broadly the provisions under the head income from house property. So now I will take up your queries. So Zahra asked, if property is not residential, then it is commercial. Then why won't it be charged under profits and gains of business or capital gains? I charge under income from house property because the charging section provides so. Charging section talks about a property. It does not distinguish between a residential and commercial house property. Only it tells that if I am going to occupy for the purpose of my own business or profession, then it will be told the annual value will not be subject to tax under the head income from. And as I told you, there's one other case where if company is engaged in the business of letting out of properties, that's its principal business, then the business is to let out properties, then it will be chargeable to tax under the head profits and gains of business. But if the house, just because the house property is a shop, it's in the nature of a shop, the charging section is only section 22. So the income from such shop will also be chargeable to tax under the head income from house property. And capital gain, so it's only in case of transfer of property. Here we are not talking about transfer of property. Property held as stock in trade is chargeable, so it means that the assessee is a real estate mostly. Yeah, real estate people who are engaged in real estate hold the property as their stock in trade. In case of deemed ownership, the income from house property is taxed under which person? Deemed owner? Deemed owner, yeah, that's why it's called an owner. Deemed owner, chargeable to tax in the hands of a deemed owner. Like for example, if I transfer my property to my spouse for inadequate consideration, to my minor son for inadequate consideration, I am the deemed owner. The income will be chargeable to tax in my hands, the deemed owner. Sums for practice, it's all contained in the study material. There are lots of sums. 4 illustrations I've already taken here because I have to cover income, profits and gains of business or profession also. On what basis expected rent can expect? That's what I told you. Expected rent is municipal, higher of municipal value and fair rent. Take the higher of the two figures. That's the step one value that you compare it with the standard rent. So the lower of two figures. So the expected rent can never exceed the standard rent. It can be lower than the standard rent. However, remember gross annual value is the higher of expected rent and actual rent. So the expected rent which cannot be higher than the standard rent. But gross annual value can be higher if the actual rent is higher than the expected rent. The actual rent is less than expected rent because of vacancy, then actual rent for 12 months will be GAV or for 9 months. Be for 9 months because actual rent is over that. That's why it becomes lower than the gross annual value. That's why you're taking the actual rent. In the example which I gave, I was talking about expected rent of 1 lakh. Actual rent was otherwise 1,20,000, 10,000 into 12. But because of 3 months vacancy, it has become 90,000. So I am now comparing 90,000 with 1 lakh. And since the actual rent is lower than the expected rent because of vacancy, in this case, the actual rent of 90,000 will be the gross annual value. The PDF, I will demand what to do with municipal tax. Municipal tax, as I said, it's what is paid by the owner during the previous year. Will be deducted from the gross annual value. Take gross annual value is the higher of expected rent and actual rent. Then what you do? That's the gross annual value, but you have to arrive at the net annual value. Na? So you deduct municipal taxes provided municipal taxes is paid by the owner. Two things are important here. It should be paid. It is not allowable on due basis. Second one, it should be paid by the owner and not the tenant. This you must be very careful because in the exam, they might not directly tell you owner or tenant. They might have given the names of the owner or tenant. So you must be careful to note who is actually paying the municipal tax. Whether it's the owner or whether it's the tenant. Because if the tenant is paying the municipal tax, then you are not eligible for deduction from the gross annual value. Only if the owner is paying the municipal tax, you will be eligible for deduction from gross annual value. Even if I'm paying arrears for this year, I'm paying arrears of 3 years municipal tax. And also it's allowable as deduction in the current year on payment basis. Provided I as the owner am paying. Payment. So two conditions for municipal tax, payment during the previous year and payment by the owner himself. And if the person is having 2 houses self-occupied but as I say given rent 1 house. But not showing. No. If you're getting any benefit from that self-occupied property, then you can't claim the benefit of nil annual value. If you let it out, then it doesn't, cannot be treated as self-occupied. Why actual rent is not considered? Because there's no, in case of deemed let out property, Nikita Agarwal has asked this question, why you don't consider? Because deemed let out property is not let out at all, actually. Which property is deemed to be let out? In a case where I have 3 self-occupied properties or in such a case, for 2 self-occupied properties maximum, I get the benefit of nil annual value. The third property will be deemed to be let out. It's not actually let out. I am not getting any rent. That's why there's no actual rent. That's why only expected rent has to be taken into account because I'm only if I actually let out the property, I will get rent from my tenant. Only in that case, actual rent becomes relevant. In case of a deemed let out property, I'm not letting out my property, but still it is deemed to be let out by virtue because I have to bring the annual value to tax under the head income from house property. But I am not actually let out the property. That's why only the expected rent will be considered. I am Tindal has asked if 2 houses are given and 1 or 2 houses considered to be deemed let out. 2 houses are given and suppose 2 houses are self-occupied. Then I can claim the benefit of nil annual value in respect of both my house properties. Only where I have more than 2 house properties, when the question of deemed to be let out arise. Up to 2 house properties, it will be treated as self-occupied property. After that, if I have 3 or 4 or 5, then the question of deemed let out property will arise. Then I have to compute it and see which is most beneficial to me. There are questions like that in the study material, but because of paucity of time, we cannot take out. There's an illustration. The 3 houses are treated to be self-occupied by the assessee. How do you compute? Find out which house to treat as deemed to be let out. It's your option because there's no compulsion. your option to treat a particular house property as deemed to be let out, you have to choose it in a manner which is most beneficial to you. What will be the annual value of house property sold between the year? It's a very good question. If the house property is sold between the year, then I own it only for part of the year. In that part of the year, it depends upon whether I have been letting out that property, or whether it's a deemed to be let out property, or whether it's a self-occupied property. Let us take it's a let out property. Till the time I'm selling the property on 1st of October. Till 30th September, it's been let out. Then for 6 months, rent I take. This is the case where I will take expected rent only for a proportional period. Because I own the property only for that period. Otherwise, normally if you see for deemed let out property also, for anything, expected rent is always for the whole year. But in such situations where I own the property itself only for part of the year, after that I'm selling the property, or a house property is under construction, the construction is completed only on 1st of October, then only for part of the year I'm actually owning the property. There I take expected rent only for part of the year. Otherwise, in all cases, expected rent will always be for the whole year. Actual rent will be for the let out period. The case which you're talking about, if I'm going to sell the property, I'm letting it out for 6 months and I'm going to sell the property thereafter. Then I take the actual rent for 6 months and compare it with the expected rent for 6 months, and whichever is higher will be my gross annual value. Municipal tax paid in advance is allowed as deduction? Yes, it is allowed as deduction. It's allowed as deduction on payment basis. I will slow down. Some people have pointed out I'm going fast. I'm sorry about that. I'll slow down. Municipal taxes actually paid as paid during the year by the owner is allowable as deduction. Why is net annual value nil in case of self-occupied property in Niharika? Again, because nil value is nil and I am not entitled to deduction of municipal taxes. So the net annual value, which is basically the gross annual value minus municipal taxes, the annual value will be nil. And in the last illustration, we saw Aparna had a house property in Pune, which she had a loan for repairs dated 1/10 and the interest is 30. How come it is restricted to 30? Should it 36,000 as it is after 30? Because it's for repairs of the property. For repairs, that's what I was telling. The entire deduction of 2 lakh is only where you borrow for acquisition or construction. If it is for repairs of the property, the maximum deduction is only 30,000. Even if I borrow it only yesterday, it doesn't depend on 31/3/2019 is 99 is relevant only for acquisition construction of property. It is not in case of repairs of property. Just go through the study material also, and I pointed it out in my lecture again that in case of repairs or reconstruction or even reconstruction, maximum deduction for self-occupied property will be 30,000 and not 2 lakh. Ma'am, if the house property is held as stock in trade after 2 years, is chargeable under PGBP? No, it is chargeable under the head income from house property. Because it is a charging section. That's why they are telling the annual value is nil. The provision is contained in income from house property. It means that once that period expires, 2-year period expires, be chargeable to tax under the head income from house property if it's held as stock in trade. Only if I'm in the business of letting out of properties, then it is chargeable to tax under the head profits and gains of business. Stock in trade means what? I am holding the property for sale of the property, not for letting out of the property. I am holding it for sale. So the annual value will be chargeable to tax only under the head income from house property. But up to 2 years, I can claim the benefit of nil. 2 years from the end of the financial year in which construction is complete, I can claim nil annual value. Thereafter, after the 2-year period, it will be chargeable to tax as income from house property. Sahu has asked how can we determine pre-construction period from the date when I take the loan till the end of the previous year, prior to the previous year in which the construction is completed. Suppose construction is completed in 30th June, as per my example. 1920, I'll get full interest. So up to the end of the previous year will be 31/3/2019. When did I take the loan? I took the loan on 1/4/2017. The period from interest for the period from 1/4/17 to 31/3/19 will be my pre-construction interest. Loan is 20 lakh in my example. 10% is the rate of interest. 20 lakh into 10% is 2 lakh. That is for 1 year. 2 years is pre-construction from 17/18 and 18/19. Both are pre-construction. So 2 lakh into 2 is 4 lakh. That's the total pre-construction interest. Allowable as reduction in 5 years. So divided by 5 will be 80,000. So that 80,000 plus the current year interest of 2 lakh, 2,80,000 will be my total interest which I am eligible for deduction. For let out property or deemed let out property, I will get the full 2,80,000. But in case if it's a self-occupied property, the 2,80,000 will be restricted to pre-construction interest is not taken in the example of Dimple and Aparna. There is no pre-construction interest in that example. That particular example does not have any pre-construction interest. The loan for acquisition, it doesn't have any pre-construction interest. That's why we will not consider. So I think I've covered most of the questions. They are repetitions. What has come later on are basically repetitions. I'll move over to the next topic, which is profits and gains of business and profession. So now we go to the next major head, profits and gains of business or profession. Here the charging section is section 28. In this case, now first of all, both income from business and profession is chargeable to tax under this head. Now, what is meant by business? Business includes any trade, commerce or manufacture or any adventure in the nature of trade, commerce or manufacture. Suppose I'm a trader also, my income will be chargeable under this head, retail trader, wholesale trader. Or if I'm manufacturing and selling goods also, it's chargeable to tax under this. Not only business, but profession. Profession has not been defined. Means an occupation requiring some degree of learning. It includes a vocation as well. We need not go into the distinction between profession and vocation because anyway, profession includes vocation. What are the profession like? If it's a doctor, lawyer, engineer, accountant, interior decorator, these are the few of examples. These are profession. So, profits and gains of business as well as profession is chargeable to tax under this. Now, method of accounting. Under section 145(1) says that income which is chargeable to tax under this head, profits and gains of business or profession, or income from other sources, shall be computed in accordance with either cash or mercantile system of accounting regularly employed by the SEC. Either cash or mercantile system of accounting which is regularly employed by the SEC. Now we come to the charging section. Like 22 was the charging section for income from house property. So the charging section for profits and gains of business and profession is section 28. So this charging section contains many items of income which are brought, but what is really relevant, I will go into it in detail because there are several other sections which are to be covered. Profits and gains of business and profession, it's very vast. So I will skip I'll go concentrate on the most significant provisions. So profits and gains of any business or profession carried on by the SEC at any time during the previous year. So what is necessary? I should be carrying on the business or profession during the previous year, at any time during the previous year. Then coming to other thing, income derived from a trade, professional, similar association from specific services performed for its members. Coming to the important thing is, in the course of carrying on my business, if I'm getting any benefit or perquisite. Whether that benefit or perquisite is convertible into money or not, and that is chargeable to tax as my business income. What happens now? Normally in your exam problem, you get a question, gives you a profit and loss account, and there are certain additional information. Certain items are debited to your profit and loss account, certain items are credited to your profit and it also contains additional information. In this case, we have seen that any benefit or perquisite, whether convertible into money or not, which arises from my business or profession. What does it mean? I am a doctor, okay, and I cure a particular patient. The patient gives me the fees in addition as a goodwill gesture. He also gives me something in kind that I am receiving in the course of my business or profession. So it is chargeable to tax. So accordingly, that is the value of benefit or perquisite which I receive in the course of my business or profession. If I'm rendering advisory services, a particular person for floating a company, then after he floats the company, he gives me some shares in the company. That again is my value or benefit which I get in the course of my business or profession. That is already been credited to your P&L account, then you need not make any adjustment. It has been correctly credited. It's taxable as my business income. However, that adjustment, if it comes as my additional information, then I have to add it back. What is the starting point for computation of profits and gains of business? Get any problem? Be the net profit as per the profit and loss account. What do you do after that? Whatever deductions are permissible, but which has not already been debited, you reduce that. Whatever has already been debited, but which are not permissible under the Act, I have to add it back. Likewise, whatever income which has been credited but which is not chargeable under profits and gains, I'll reduce it. And whatever is chargeable to tax under profits and gains but which are not credited to my P&L account, I'll have to add it back. This we will understand slowly, but these are just the simple things. What I actually have to bring to tax, I have to add it if it's not already credited. What is not chargeable to tax which has already been credited, I have to reduce. Whatever items of expenditure which is allowable but not debited to my P&L account, I have to reduce. Whatever is disallowed but which has already been debited to my P&L account, I have to add. So what generally is value of benefit or perquisite, how does it come in the exam? It comes as an additional information, which means it has not been credited to my P&L account. In which case, I have to add this value when I am computing to the net profit, when I am computing my profits and gains of business. If it's already been shown as credited to P&L account, then you need not do any adjustment. But if it comes under additional information, you have to add it. Then any interest, salary, bonus, commission due or received by a partner come from a firm. To the extent it is allowed as deduction in the hands. So, the firm is also another assessee. It pays salary to partners, it pays interest to partners. Thus, salary and interest is allowable as deduction subject to fulfillment of certain conditions, which we will do when we are dealing with that respective provisions. It comes under 40B. So, it is allowable as deduction. And to the extent it is allowable as deduction in the hands of the firm, the same extent it will be chargeable to tax in the hands of the partner. Whatever salary is allowable as deduction in the hands of the firm will be charged to tax in the hands of the respective partners. As my profits and gains of business or profession. Share income of a firm partner is exempt. Number share income is exempt under section 10. But if salary or interest I get from a firm, that will be chargeable to tax to the extent the firm has got deduction. I'm still in the charging section, section 28. What are all chargeable to tax under section 28? Then any sum received or receivable in cash or kind under an agreement for not carrying out any activity in relation to business, not sharing any know-how, patent, copyright, trademark, or any other business or commercial right of similar nature. What does it mean? See, suppose I'm a partner of a firm. Okay? I retire from that firm. The firm is going to pay me some particular amount, enter into an agreement with the firm that whatever the business the firm is carrying on, of which I also have a good knowledge because so long I've been the partner of the firm. Okay? But once I retire from the firm, I agree for this many period, 5 years or so, I will not carry on the same business. And for that, the firm pays me some money. It pays me 5 lakh rupees. This is a non-compete fee. It's called a non-compete fee. It is chargeable to tax in my hands as my business income. What the firm pays me, chargeable to tax for not going on a competitive business, the non-compete fee. Similarly, if I get any amount for not sharing any know-how, copyright, patent, it again is chargeable to tax under the head profits of the business owner. Then any sum received under a Keyman insurance policy, including the sum allocated by way of board. So what is a Keyman insurance policy? What does it mean? What do you mean by a Keyman? See, like big companies and all, for them the Keyman is a very important resource person for the company. Maybe the CEO of the company, maybe the CFO of the company, who are very valuable to the company. So the company takes an insurance for the Keyman. They pay the insurance premium for the Keyman. Now, if some mishap happens to that particular Keyman and the company gets the insurance proceeds, in that case, it will be chargeable to tax in the hands of the company as profits and gains of business or profession. In such a case, whatever insurance proceeds which the company gets out of the Keyman insurance policy will be chargeable to tax under the head profits and gains. But in a case where the Keyman, he leaves the company, he leaves the company and thereafter the policy is assigned to him, then whatever sum of money which he gets will not be chargeable to tax under the head profits and gains of business or profession. It's only what the employer receives. That is chargeable to tax under the head. The employer receives the money on account of some mishap, then that is chargeable to tax under the head profits and gains of business and profession. Fair market value of inventory on the date on which it was converted into or treated as capital. Inventory is something which I hold for my business purposes. Capital asset is not what I hold for business purposes. Suppose I'm a dealer in property. I'm a dealer in property. Buildings are my inventory. Now one particular flat I like very much. So I decided that I will use that flat for my own residential purposes. I'm holding it for inventory for some period of time. Then on 1st of June 2019, I decided that I like that flat very much. I'm going to use for my personal purposes. So what is happening? My inventory, I'm converting it into my capital asset. So what is the fair market value on the date of that conversion? That would be my profits and gains of business or profession. Thereafter, after a couple of years when I'm going to sell that capital asset, then this fair market value on the date of conversion will be treated as cost of acquisition. Will be dealt with in capital gains, but just for understanding, this fair market value, as on date, when in the year in which I am so converting it into a capital asset, will be deemed to be my business income. Another one case is a case where I have been allowed deduction under 35AD. 35AD is an investment linked tax deduction, which a tax deduction for capital expenditure incurred in case of specified businesses, like hotels of 2-star category above, hospitals with 100 beds, cold chain business, etc. For certain specified businesses, they enjoy the full capital expenditure as deduction under 35AD. Now, in such cases where I get my full capital expenditure as deduction, if I subsequently sell my property or the property is demolished, destroyed, discarded, then the whole of the expenditure which has been allowed as deduction will be chargeable to tax as my profits and gains of business income. So it might be a little bit difficult at the first instance, but what you basically have to remember, the very first provision, that is profits and gains of any business or profession carried on by the assessee at any time during the previous year, that is chargeable to tax. And in the course of my business or profession, if I am getting any benefit or perquisite, value of that benefit or perquisite is chargeable to tax under this head. I am a partner of a firm and I get salary, interest, bonus, commission from the firm. To the extent it has been allowed as deduction in the hands of the firm, that will be chargeable to tax in the hands of partner as his business income. Then any amount which I receive as non-compete fee, which I am being paid for not carrying on similar business, for not competing with somebody else, I am being paid some money. That amount is my business income. These sum which I receive as an employer for the keyman insurance policy which are taken to insure the life of a keyman. Maybe a CFO, CEO, if as an employer I have taken insurance policy on the name of the keyman and then I am getting the proceeds of that policy as an employer, chargeable to tax under the head profits and gains of business and profession. Then the fair market value of the inventory which has been converted into capital asset. As I told you, if I'm a dealer, I deal with property, it's my inventory. I like one of the properties, I decide to use the property, that means I converted it into my capital asset on, say, if I'm using it from 1/6/2019. So fair market value on 1/6/2019 will be deemed to profits and gains of business or profession. And last one, any capital expenditure has been fully allowed as deduction under 3580 of the specified businesses. That the asset has been sold, discarded, demolished, destroyed, and the whole of the expenditure which is allowed as deduction will be deemed to be my chargeable to tax under section 20. Okay? But we have written other than land, goodwill or financial instrument because these capital expenditure will not have been allowed as deduction in the first place. Because it was not allowed as deduction, even if it is destroyed or whatever, it will not be brought to tax under section 20. That is the reason why other than land, goodwill or financial instrument. We'll look at it when we come to section 3580. Now, how do I go about computing my income under the head profits and business? So, as per section 29, the income whatever is referred to in section 28, whatever we talked about so far, has to be computed in accordance with the provisions contained in 30 to 43B. Okay? So 30 to 37 spells out the deductions. Thereafter 40, 48 tells about the deductions which are not allowed. So all these provisions have to be taken into account while computing income under the head profits and gains of business. What are the admissible deductions? I am computing my income under the head. What are the admissible deductions? First, section 30 tells that we talking about phase now, phase. Section 30 tells about any amount which I am paid on account of rent, rates, taxes, repairs, and insurance for the building which I am using for the purpose of business or profession. Suppose I am using a building for the purpose of business or profession. Then any rent, rates, taxes, repairs, and insurance which is being paid for the building is allowable as deduction, except the capital repairs of capital nature is not allowable. Current repairs are allowable. The repairs are of capital nature, then that will not be allowable as deduction under section. But suppose I'm occupying the premises as a tenant, then the amount of repairs will be allowed as deduction only if I have undertaken to bear. Only the tenant has undertaken to bear the cost of repairs, only then it will be allowed as deduction. If it is not undertaken to bear, then it will not be allowed as deduction. But if suppose you get an item of adjustment, the examination, then you give a suitable assumption in this regard. Then if the tenant has agreed to bear the repairs or not, suppose the question is silent, then give an assumption and proceed to answer it. 31 tells about current repairs and insurance of machinery, plant and furniture. That will be allowed, which is used for the purpose of business or profession. 30 also, the building should be used for the purpose of business or profession. 31 again, the repairs and insurance of machinery, plant and furniture is used for the purpose of business and profession. So it's very important that the assets should be used for the purpose of business or profession. Only then these deductions will be admissible. Then section 32 is depreciation. Depreciation is what? In accountancy terminology, simply wear and tear of the asset, allowance for wear and tear. The Income Tax Act, depreciation is mandatorily allowable. I don't have an option. I have to claim depreciation. But what are the conditions for claiming depreciation? Because I must use the asset for the purpose of my business or profession at any time. Suppose in the exam it is given that motor car, 1/4 I am using for my personal purposes, 3/4 I am using for my business purposes. Then depreciation, when I calculate, only 3/4 I will allow it as deduction. Calculating my profits and gains of business. part of the asset has been used for the purpose of business or profession, then or 3/4 of the time of usage is for the purpose of business or profession, and proportional expenditure will also be only allowed as the purposes of business or profession. Suppose I incur repairs for motor cars, there again only 3/4 of the repairs will be allowed because 1/4 I'm using for my personal. The asset is acquired during a particular previous year and is put to use for less than 180 days in the period. Only 50% of the depreciation rates is allowable. See, the depreciation rates and all have been specified. The Rule 5, appendix to Rule 5. So in that, the rates are specified. Suppose the rate of depreciation for plant and machinery is 15%. Plant and machinery I purchased this year, I purchased only in December. So I put to use only for a period of 4 months, it's less than 180 days. Then only 50% or 15%, 7.5% would be allowable in respect of the plant and machinery which I purchased in the month of December. This asset should be owned by the assessee wholly or partly. If it's partly owned, then to that proportional extent you will get the benefit. Then the depreciation under the Income Tax Act is allowed on the basis of block of assets, the prescribed rates. Except in case of power generating units, depreciation has to be calculated as a percentage of actual cost. But even power generating units can exercise an option before the due date for filing of return to claim depreciation under WDV. They can exercise an option and claim it on WDV. Otherwise, normally they have percentage of actual cost. All other assets are on written down value of block of assets. The prescribed rates are prescribed in the annexure to the Rule 1, appendix to Rule 1. Sorry. So what do you mean by block of assets? Block of assets means a group of assets falling within a class of assets comprising of building, machinery, plant or furniture, tangible assets. We have building, machinery, plant, furniture, intangible assets, or know-how, patents, copyrights, trademarks. These are intangible assets. Business or commercial rights of a similar nature. There are tangible assets, buildings, machinery, plant or furniture. Then there are intangible assets, in respect of which the same rate of depreciation is prescribed. This is important because even in the buildings there can be 4 categories, 4 different rates are prescribed. Plant and machinery, there are several categories. The general rate is 15%, but computers also comes under plant and machinery, it has 40%. Books also come under plant and machinery, that again has 40%. So, 40% asset will be in a different group, the 15% asset will be a different block. 50% will be a different block, 15% will be a different block, even though the same are plant and machinery. That we have to take. Like for example, let me give you now motor cars. Motor cars, other than used for the business of running them on hire, the rate of depreciation prescribed in the Act is 15%. But recently, in order to give some benefit to the for purchase of motor cars, they've increased this rate. In respect of motor car purchased during the period from 23rd August 2019, 31/3/2020, and put to use on or before 31/3/2020 to have a higher rate of 30%. Same asset, but only thing, if it's purchased during this period, 23rd August to 31st March 2020, and put to use before 31/3/2020, you get a higher rate of 30%. This is given in your RTP, so your statutory update. So we can see the asset is the same, but even then, because a different rate of depreciation has been prescribed in respect of the same asset, so it becomes different block of assets, not falling within the same block. Even though the asset is motor car, which is not used for the purpose of running on the hire, still there are 2 different blocks of assets because 2 different rates are prescribed. How do you go about computing written down value of assets? Written down value of the block of assets on 1st April of the previous year. 1st April of the previous year, opening balance, add actual cost of assets acquired during the previous year, then you get a particular figure. From that figure, you reduce money is receivable, where you sell the asset or the asset is demolished and any money is receivable, that you reduce. Then you get WDV at the end of the year. It is the closing WDV on which you have to allow depreciation at the rate prescribed. Rate of depreciation, suppose it's a plant and machinery block. Under 15% rate of depreciation is 15% into closing WDV. That will be the rate of depreciation. That will be the amount of depreciation. Now, how do I actually compute it? Suppose my WDV at the end of the year is say 3 lakh. Okay? And actual cost of assets acquired during the year, suppose the actual cost of asset acquired during the year is 1,50,000, and out of which 1 lakh I have acquired in December. So for that 1 lakh acquired in December, I am not eligible for 15% depreciation because I put to use for less than 180 days. For that 1 lakh, I will be eligible for depreciation only at 7.5%. So if my closing WDV at the end of the year is 3 lakh, from the 3 lakh, I first have to reduce 1 lakh. Because that is the asset which has been put to use only for less than 180 days during the previous year. For the remaining 2 lakh, I provide depreciation at 15%. And for that 1 lakh, I provide depreciation at 7.5%. When I add up these two figures, that would be the total depreciation. So if actual cost of assets comprise of any assets which have been put to use for less than 180 days during the relevant year, then in respect of that portion of the actual cost, I have to first reduce it from my written down value. In this case, it's 1 lakh, I reduce it from 3 lakh. Remaining 2 lakh, I provide depreciation at 15%, and for 1 lakh, I provide depreciation at 7%. Now, there are certain things which I have to remember when I'm adding the actual cost of asset acquired. Suppose I make a cash payment, like if the value of the asset is more than 10 lakh, making a payment of more than 10 lakh in respect of that asset. Then, to make it by account pay check or account pay draft or electronic clearing system or any other prescribed electronic mode, like debit card, credit card, RCGS, and all. But if I'm not doing like that, if I'm making a cash payment, the cost of my asset is 1 lakh, say, it is more than 10,000, any figure more than 10,000, even if it's 12,000. So, that portion, whatever I am paying otherwise than by way of account pay check or bank draft or ECS, that will not form part of my actual cost. I will not be entitled for benefit depreciation in respect of that portion. This is to discourage that kind of payments, discourage cash payments. You make your payment by account pay check, make your payment by account pay bank draft, make it through electronic clearing system, then only you get the benefit of it. So up to 10,000, it's okay. I can make any kind of payment. But once the amount crosses 10,000, I have to make it by account pay check or bank draft or prescribed electronic. Also, actual cost of an asset acquired. Suppose I have the government gives me subsidy to purchase plant and machinery. And to the extent that actual cost is met by the government, suppose the cost of the asset is 3 lakh, government gives me a subsidy of 2 lakh. My actual cost will only be 1 lakh because that's the amount which I have due. The other amount, 2 lakhs, is through by way of government subsidy. Then we talked about a capital expenditure, the 35 AD deduction for specified business. For entire capital expenditure, I'm getting a deduction. Once the 100% of capital expenditure, 3 lakh I'm incurring, 3 lakh I'm getting a deduction under 35 AD. Again, that cannot form part of my actual cost. So that, in that case, my actual cost will become nil because the whole of the amount is allowed as deduction under 35 AD. These are the things. The actual cost contains many of such instances. You have to go through all the particulars given in the study material. It's contained in section 43 as to what you should include and what you should not include in the actual cost of assets acquired. Likewise, if a building which I've been using for my personal purposes, I bring it for my business purposes, then the actual cost of acquisition minus depreciation that would have been allowed had that building been used for business purposes from day one. If I reduce that amount of depreciation, and that would be my actual cost as on date. For each and every instance, they've given details as to what will be the actual cost. You have to go through it in detail. Now, whatever rates of depreciation are prescribed. Rates of depreciation, what I talked about there, what a general rate of depreciation for plant and machinery is. Furniture and fixtures, it's 10%. For buildings, it's 10%. There are other rates also, but general rates are getting. Computers, it's 40%. Books, it's 40%. Maximum depreciation rate cannot exceed 40%. Then for intangible assets, it's 25%. So these are broadly the rates, but the study material also contains in detail the other rates also. So you can go through the rates. You must be aware of the general rates in any case. Now, that is the normal depreciation. But 32(1)(2)(a) also provides for additional depreciation. It's an incentive which is given. Incentive is not given for all assets. It's given only for plant and machinery, new plant and machinery. And by whom? By an assessee engaged in manufacture or production of any article or thing, or in the business of generation or transmission or distribution of. So this is the precondition. Assessee should be engaged in the business of manufacture or production of article or thing, or in the business of generation, transmission or distribution of power. So for these assessees, if they invest in new plant and machinery, then in addition to the normal depreciation, they get 20% of the actual cost of plant and machinery acquired or installed, then additional depreciation. Here again, if the building is put to use, if the machinery is put to use for less than 180 days, then instead of 20%, you will get only 50% of 20%, that is, you get only 10%. Here, suppose the machinery is acquired and installed in December, November or December, or January, February, March, whatever. In October, you have to see the date, which falls within 180 days, which falls beyond 180. So accordingly, if it is less than 180 days in the year, if I put to use, it's not the ownership. I may have purchased it in September also, but if I put to use only in November, fall under less than 180 days. So putting to use here again is not done. If I put to use for less than 180 days, here again I'll get only 10% of the actual cost of plant and machinery. The remaining 10% I can get it in the next year. This year I will get 10%, next year I will get 10%. Now, the exam, how would it come? Suppose you have to see whether the assessee is engaged in the manufacture or production of article or thing, or he is engaged in the business of generation or debt. Only in these two cases he will be entitled to additional deduction. Other assessees are not entitled to additional depreciation. One more thing is that how is it given as? Is it given as an additional information? We generally given as additional information, so accordingly you have to see. Suppose sometimes they would have given the date, like last year the asset was acquired as an additional information. They would have given this information. But last year the plant and machinery was acquired in December 2018 and put to use in December 2018. Why are they giving information relating to last year? Because your assessment year is 2020-21. Your previous year is 2019-20. Why information is given relating to last year? Because last year what would have happened? He had acquired the asset only in December. Would have been given only 10% additional depreciation. Balance 10% additional depreciation is allowable this year. So when I'm computing the profits and gains of business and profession, I have to allow 10% of the actual cost of plant and machinery purchased last year and put to use for less than 180 days in the previous year also. That is generally given as additional information, and I have to provide for the balance 10% additional depreciation in the current year. But remember, additional depreciation is not allowed on second-hand plant and machinery. It is not allowed in respect of the machinery is installed in office premises, residential accommodation, guest house. I don't get additional. Second-hand plant and machinery, I don't get. In machinery, the whole of the actual cost is fully allowed as deduction in any one previous year. If I've got 35 AD deduction, investment linked tax deduction, then also I won't get additional depreciation. I won't even get normal depreciation for that. Ships, aircraft, road transport vehicles, office appliances don't get additional depreciation. So for all these assets, I don't get additional depreciation. So normal rate is 20%. If I put to use for less than 180 days, it's 10%. Then to encourage acquisition and installation of plant and machinery, for setting up manufacturing units in notified backward areas. These certain areas have been notified as backward areas for the purpose of investment allowance. I'll just first take you to investment allowance before coming here. (32) AD provides for setting up industrial undertaking in backward areas in the states of Andhra Pradesh, Telangana, West Bengal and Bihar. In Andhra Pradesh got split up into Andhra Pradesh and Telangana. This provision came in the Income Tax Act to encourage setting up of industrial undertakings in these backward states, and thereafter West Bengal and Bihar are also included. But in the notified backward areas in these states, then 15% of the actual cost of new plant and machinery acquired and installed will be allowable as deduction under 32AD. Okay? So the assessee should be set up an undertaking or enterprise for manufacture or production of an article or thing on or after 1st April 2015. The backward area notified by the central government, these 4 states: Pradesh, Telangana, Bihar, West Bengal. So if you set up an industrial undertaking for manufacture or production of article or thing in the notified backward areas in these 4 states, you are eligible for, after 1/4/2015, you are eligible for 15% of actual cost of new plant and machinery acquired and installed. The assessee, one other condition is there: the assessee should acquire and install new plant and machinery for the purpose of the undertaking during the period between 1/4/2015 and 31/3/2015. Because previous year 1920 also, if he installs new plant and machinery, he would be entitled to benefit of 32AD. 15% of the actual cost. Okay? So this is the benefit that is being given. For these assessees, there is another benefit. What is the other benefit? Normally you get additional depreciation at 20%. For these assessees, you get additional depreciation at 35%. Enhanced rate of 35%. If you are doing manufacture or production of an article or thing, the notified backward areas of Andhra Pradesh, Bihar, Telangana and West Bengal get higher additional depreciation of 35%. Here again, you have to reduce it to, 50%, that is 17.5% if it's put to use for less than 180 days. Balance 17.5% will be allowable in the immediately succeeding previous year. Take a break or something. Not able to view the screen here. Generally the chat doesn't come here, na? So, okay, we continue then. Doesn't matter. So we've seen 32AD. So if you set up an industrial undertaking in the notified backward areas in the states of Andhra Pradesh, Bihar, Telangana and West Bengal, 2 benefits you get. One is 32AD में 15% of the actual cost of new plant and machinery installed. The other one is 35% additional depreciation. Normal depreciation you will get in any case. Additional depreciation, instead of 20%, it's 35%. Suppose you put to use for less than 180 days, you will get 50% of 35%, that is 17.5%. Remaining you can claim in the next year. Section 35 again is a very important section on expenditure on scientific research. Now, here there are 2 categories. One, I actually incur the expenditure relating to my own business. I incur the expenditure on in-house scientific research. The one is I contribute to a scientific research association, or I contribute to an IIT or a national laboratory. 2 types. So, what is the benefit? So, I am undertaking scientific research for my own this is related to my own business. Any revenue or capital expenditure other than cost of living which I incur on my scientific research is allowable as well. Okay. The cost of land is not allowable, but any other revenue or capital expenditure which I incur during the scientific research is allowable as deduction. Now, suppose I am commencing my business, and prior to commencement of my business, I have incurred expenditure. Some capital expenditure I have incurred, some revenue expenditure I have incurred, I have paid salaries, I have purchased materials for the purpose of scientific research. Is that allowable? Yes, that is also allowable, because prior to 3 years prior to the immediately preceding the year of commencement of business, if I have incurred such expenditure within 3 years prior to the year of commencement of business, the revenue expenditure by way of salaries or raw materials or materials inputs or capital expenditure other than land, and it is deemed to have been incurred in the year of commencement of business. Here again the deeming provision. Even though I incurred it in the last 3 years, it's deemed to have been incurred in the year of commencement of business, and I'll get deduction for that expenditure also. Then capital expenditure as well as revenue expenditure. Then suppose I'm a special category company. All these are 100%. Actual expenditure I incur everywhere. But if I'm a special category, if I'm a company engaged in the business of biotechnology or in the manufacture or production of an article or thing, other than an article or thing listed in the 11th schedule, then I get a weighted deduction of 150% of the scientific research expense incurred by me, both capital and revenue, other than cost of land and building. Here I won't get building deduction. I won't get a weighted deduction of 150%. I get revenue expenditure and any other capital expenditure other than land and building. So any other capital expenditure, I will be eligible for 150%. But I should be a company engaged in the business of biotechnology or manufacture or production of an article or thing other than an article or thing listed in the 11th schedule. What does 11th schedule contains? Contains sin goods like alcohol, cigarettes, then it also contains chocolates and dental creams, cosmetics, all these. If I am engaged in the production of all these items, then I am not eligible for this weighted deduction. Manufacture or production of an article or thing other than an article or thing in the 11th schedule. Then I get 150%. The benefit here I am getting a weighted reduction in respect of my expenditure on scientific research, both revenue and capital expenditure, including cost of land or building. Here kindly note if I am an assessee, if I am entitled to a 35(2)(ab) deduction, 150% deduction. I have also incurred expenditure on building. However, that doesn't qualify here, 150%. However, building qualifies under the normal provision, 35(1). You get 100% deduction in respect of building, but not 150% deduction under 35(2)(b). So even if the company has incurred expenditure on building, it will get normal deduction at 100%, but not weighted deduction at 150%. Cost of land I will never get in any provision. So what about contribution to outsiders? These are all in-house research, what we saw under 35(1), 35(2)(ab). So contribution to outsiders, how do you? Suppose I am contributing to a notified approved research association for the purpose of scientific research once again, to a research association, to a university, college or other association. For scientific research, it's 150%. In these people, I am contributing research association, university, college or other institution for social science or statistical research. Then I fall under 35(1)(3). Then I get only 100%. Kindly note, if it's for scientific research, it's 150%. If it's for social science and statistical research, it's only 100%. I am contributing to a notified company for scientific research. If I am contributing to a notified company for scientific research, maybe for scientific research, but then if it's up to a company, it's only 100% under 35(2)(a). Then if I am contributing to an approved national laboratory, university, IIT, or specified person, then 150%. Here again, weighted deduction, I am entitled to 150%. Now, how does it come in your exam problem? Exam problem, they might, normally how it comes is that they've given the actual contribution is be debited to P&L account. Suppose I am contributing to a company for scientific research, actual contribution is debited to P&L account. I need not do anything further because I am getting only 100% deduction. No adjustment required. Suppose the same contribution for scientific research is to a university or to a research association. Then I am entitled to 150%, but only 100% has been debited into my P&L account. So I have to reduce further 50%. 2 lakh is the contribution which I am doing. 2 lakh is debited to P&L account, but I am entitled to benefit of 3 lakh. So another 1 lakh I deducted from while computing my profits and gains of business and profit. However, I am entitled to 150% deduction. The actual expenditure has been debited to my P&L account. Remaining 50% I have to deduct while computing my profits and gains of business. Now it's 9:05. We will take a short 5-minute break and come back. Short break and we'll come back with section 35. I'll continue to share this screen. Hello, I'll stop sharing the screen then. Yeah. Yeah, we'll start. Okay, now we come to section 35AD. I believe you were not able to hear the voice properly. If you have any specific doubts, you can raise, because I were not able to hear last 5 minutes. Accordingly, I will do. We were doing with dealing with scientific research, expenditure on scientific research, which is allowable as deduction. Cost of land is not allowable. All other capital expenditure and revenue expenditure. For weighted deduction under 35(2)(ab, it is allowable to some assessees engaged in the business of biotechnology or manufacture or production of particular thing other than an article or thing in the 11th. Get a weighted deduction of 150. But here, you won't get in respect of building. Building, you'll continue to get only at 100%. All other assets can get it. Capital expenditure and revenue expenditure. Cost of land is never eligible. Whether the 35(1) or 35(2)(ab, you won't get towards cost. Otherwise, for contributions, as per this list, 35(1)(2), if it's for notified approved research association for scientific research, 50%. Notified company for scientific research, it's 100%. Research association, university, college, other institution for social science or statistical research, it's again 100% only. The National Laboratory, University, IIT for approved scientific research program, it's 150. Cases which are eligible for 150% weighted deduction. Normally in your exam question, they would have stated that only the actual expenditure would have been debited to the profit and loss account. So you have to provide that additional 50% in cases where the expenditure or the contribution qualifies for a weighted deduction. Now we come to 35AD. We've already dealt with 35AG at the time when we did section 28 also. The time when we did depreciation also. But with respect of investment, it's called an investment linked tax deduction. Not everybody gets it. It's only for specified business. Cold chain, setting up and operating cold chain facilities to commence operations on or after 1/4/2009. Because that is important. For those businesses, similar businesses which commence operation before that date, not eligible for 35AD. Then operating warehousing facilities for agricultural produce. Here again, operations should have been set up. Operations should have commenced on or after 1/4/2009. Then laying and operating a cross-country natural gas or crude or petroleum oil pipeline for distribution, including storage facilities. Here you should have commenced business on or after 1/4/2007. Building or operating anywhere in India, a total of 2-star or above category on or after 1/4/2010. Hospitals with 100 beds for patients, again on or after 1/4/2010. Housing project under notified scheme for slum development on or after 1/4/2010. There's a list. Affordable housing on or after 1/4/2011. Production of fertilizer 1/4/2011. Then operating in inland container depot or container freight station on or after 1/4/2012. You see, for this, the date given is different. Because this list, it started off in 1/4/2007, then they kept on adding more and more businesses to the list, and accordingly the date was a later date because it was added at different points of time. The dates, accordingly, they placed the condition that it should start only on or after this particular date for being eligible for that deduction. Warehousing facility for storage of sugar, so many other things along with the dates. Then any developing, maintaining, operating any infrastructure facility on or after 1/4/2017. This is the latest added to. These are the specified businesses. They have commenced the business after the date specified there. What is the benefit? What is the investment linked tax deduction which you get? Entire capital expenditure. 100% of the capital expenditure is allowable as deduction, which is incurred only and exclusively for the purpose of business. 100% of the capital expenditure. Just say in a normal business, you just get depreciation at 15%. Here you get 100% of the depreciation. Except expenditure on land, goodwill or financial instrument will not qualify under 35AD. Capital expenditure, you get 100% deduction in the very first year. The very first year, when you commence business, you get this deduction. And thereafter also, if you incur capital expenditure, you get 100% deduction. But only restriction here is, this case, of course, if I am claiming 100% of my capital expenditure as deduction for these businesses, it will end up being a loss most cases. Then how do I set off the loss? Can I set it off against my normal business? No, I can't set it off against my normal. I have to set it off only against any other specified business. But when I'm going to set off against any other specified business, there these commencement dates are not material. Even if I commenced hotel business in way back in 1999, that will also be treated as a specified business for the purpose of set off. Not for the purpose of deduction under 35AD, but against the income from that business, I'll be able to set off my loss. That's what it means. Irrespective of the date of commencement of business, I'll be able to set off my losses against the income from that business. But I can't set it off against any other business. Now, 100% of the capital expenditure is allowed as deduction. Not only the capital expenditure which I incur after the commencement of business, but even prior to commencement of business, if I incurred a capital expenditure and capitalize it as on the date of commencement of business, then that will be allowed as a deduction in the year of commencement. Here again, see, just like we said that if suppose a payment exceeding 10,000 is made, otherwise than by way of account paying check or bank draft or ECS or prescribed electronic notes, if it's made in any other manner, if it's made in cash to be simpler, then what will happen? I won't include it in actual cost for computing depreciation. Similarly, I won't qualify for deduction under 35AD. Suppose I've incurred expenditure of 3 lakhs or 4 lakhs or 10 lakhs. Okay, and I've made payment otherwise than by the prescribed rules. Then that expenditure will not qualify for section 35AD deduction. This is to discourage all other forms of payments. Only payment by account pay check, account pay bank draft, ECS and prescribed electronic modes to be permissible. Government wants to discourage cash payments. Assessee who has availed the benefit under 35AD, of course, he has availed a huge benefit. The entire capital expenditure is claimed as deduction. He is not eligible for any profit-linked deduction under Chapter 60. TIA, TIB, we're all not dealing with it at the intermediate level, but the assessee will not be eligible for that. He will not be eligible for deduction under Section 10A, respect of units in special economics. He will not be entitled. Then set off or carry forward a set off from specified business. As I've told you, there's a loss from specified business. I can set it off only against a profit from specified business. Suppose, otherwise I keep on carrying it. Only thing, I don't have a maximum time limit for carry forward or loss. It can keep forward indefinitely, but I can set it off only against profit of any other specified business it can be. And when for that specified business, I need not be bothered about the date of commencement. Against whose profits I'm going to set off my Assessee can therefore set off loss of a hospital which begins to operate on or after 1/4/2010, which is eligible for deduction under 35AD, against the profit of existing business of operating a hospital with at least 100 beds of patients, or a hotel business of 2-star or above category, even if the latter not eligible for deduction under Section 35AD. Again, the profits against whom I'm going to set off my losses, that business need not be eligible for 35AD. However, be a specified business. One more condition is that I'm giving such a huge benefit to the assessee and other. Entire capital expenditure is there. There should be some restriction. Now, the assessee part also there should be some commitment. What is the commitment which the government is expecting from the assessee? That I don't use that asset for any other purpose other than my specified business for a period of 8 years from the end of the beginning of the previous year in which the asset is acquired or constructed. For a period of 8 years, I don't use it. I should not use it for any other purpose. If I'm not carrying on any other business, I should not use it for that business. What will happen if I so use it? If I use it after a period of 6 years, then the deduction under Section 35AD, which has been allowed to me, will be deemed to be my business income. Whole of deduction minus the depreciation would have been allowable, because normally if I'm allowed deduction under 35AD, I'm not eligible for depreciation. But once it is decided that deduction itself, I'm going to treat it as my income because I did not comply with the condition of usage in my specified business for 8 years. Because I'm not complying with that condition, I'm going to treat it as my business income, then I should be allowed to at least claim depreciation. So depreciation, I should compute for that period, and then 35AD deduction, whatever I've claimed, minus that depreciation, that figure will be deemed to be my business income the year in which it's so used for some purpose other than my specified business. This is when I've stopped using it for my specified business before 8 years. After 8 years, if I do it, there is no tax consequence. After the 8-year period, if I use it for some other purpose, there is no tax consequence. Then it won't be deemed to be the income. So in the exam problem, if suppose they give any of these businesses the question, and then they give capital expenditure also. What a student will do in the hurry, once they see capital expenditure, they see assets, they might start claiming depreciation. So you have to note if it's a specified business and if it's commenced after that specified date, then you have to provide 35 deduction because that would be more beneficial to you. And that is a separate business. You have to segregate it from the normal business you are doing, computing deduction under 3580. Next is preliminary expenditure. Preliminary expenditure, what is deduction of preliminary expenditure incurred by Indian companies and resident non-corporate associates. What is preliminary expenditure? When I commence a new business or when I extend my undertaking or when a new unit commences operations, then I incur some expenditure on preparing project report, stability report, market survey, engineering services, legal charges for drafting of agreement. If I'm a company, then legal charges for drafting my memorandum articles of association, printing of memorandum articles of association, fee which I incur for registering the company, share issue expenses like underwriting commission. All these are the preliminary expenses. These preliminary expenses will be allowed as deduction over a period of 5 years, beginning with the previous year in which the business commences, case of commencement of new business, or in the previous year in which the expansion is completed, or when a new unit commences operation, as the case may be. Over a period of 5 years. So only 1/5 will be allowable in the current year, 4/5 will not be allowable. So if suppose the entire amount has been debited to P&L account, so only 1/5 will be allowable. Suppose 5 lakh is the preliminary expenditure. 5 lakh has been debited to P&L account. See, 1 lakh is allowable in the current year. Balance 4 lakh, I have to add it back when I am computing my profits and gains of business operation. But there is a cap on these expenses. You can't, not without any limits that I can claim. Maximum cap preliminary expense, suppose I incur an expenditure of say 20 lakhs. But it has to be restricted to 5% of cost of project. Suppose my cost of project is 5 lakh or I have debited 20 lakh, whatever I have incurred, then only 1 lakh is allowable. Remaining amount I have to add it back while I am computing my profits and gains of business. In case of an Indian company, 5% of cost of project or 5% of capital employed by the company. Whichever is higher, I can take it as the cap. Capital employed by the company is the aggregate of issued capital, debentures and long-term borrowings on the last day of the period. Yeah, I have my option. I can cap it at 5% of cost of the project, or if my capital, 5% of capital employed happens to be a higher figure, then it's more beneficial for me to take 5% of capital. So I take that figure and 8 lakh that I divide it over a period of 5 years. The remaining amount has to be decided. The next one is 35 DDA. Expenditure in connection with voluntary retirement. What is this? I'm an employer. One of my employees want to retire voluntarily. Not attain the retirement age, but he wants to voluntarily retire. He has completed 20 years of service. He wants to retire. So I give him some compensation in appreciation of his years of service. As per the scheme framed, I give him compensation. So this voluntary retirement VRS which I frame in accordance with the scheme, I am entitled to 1/5 of the amount paid the current year. It's allowable as deduction in 5 equal installments spread over 5 years. Suppose I paid him 5 lakh. 1 lakh is allowable in the current year. Remaining 4 lakh will be allowed in the next 4 years. So in the exam problem, if 5 lakh has been shown debited to P&L account, the 1 lakh will be allowed. Remaining 4 lakh, you have to add it back. So profits and gains of business. Whenever you do any such adjustment in the exam, okay, please give one liner why you are doing it. Why are you adding back 4 lakh? Because only 1/5 is allowable as deduction in the current year. Write it, mention it. You need not write a detailed story because you won't have time. Only 1/5 of the expenditure allowable in the current year. Hence, balance 4/5 the added back. Bus. Have to write this much because that every addition or reduction in computing profits and gains of business and profession should be supported with a very brief reasoning. Then interest paid in respect of capital borrowed for the purpose of business or profession. Now, if I'm borrowing some money for the purpose of my business or profession, that is fully allowable as deduction. However, if I'm interest paid for acquisition of an asset, whether I capitalize it in my books or not, prior to the period for which the asset is first put to use. Suppose I borrow the money, Pan 4 2018, purchase of an asset, and I'm putting the asset to use only on Pan 4 2009. So the period of 1 year, or it might be even a shorter period, it might be 3 months, it might be 4 months, whatever the period is. Just for the period prior to commencement of operating, prior to the period in which the asset is first put to use. That interest has to be capitalized. That is not allowable as revenue expense. Suppose the total interest is 1 lakh. So interest prior to the period out of which I got, suppose the interest is 1 lakh. The interest after the period the asset is first put to use is 60,000. Then only 60,000 will be allowable as deduction. I have 1 lakh has been debited to the P&L account. I have to add back 40,000 because that amount has to be capitalized. What do? I capitalize. Suppose it is towards plant and machinery. 40,000 is prior to the date in which the asset is first put. I add it back to the cost of the asset and I provide depreciation on that. So that is how 40,000 the treatment will be for 40,000. Then the next one is 3614 is any sum paid by the assessee as an employer towards contribution towards recognized provident fund or approved superannuation fund. That is deductible. Likewise, any sum contributed by the employer through a pension scheme under 80CCD, the notified pension scheme of the government under 80CCD, that will qualify for deduction up to a maximum of 10% of the salary of the employees. Salary here includes basic salary plus dearness allowance if it forms part of it. So up to 10% of salary, it will qualify for deduction. If it's more than 10%, you have to restrict it to 10%. Suppose in the exam problem, they have given an amount, then you have to calculate 10% of the salary, restrict it to that particular amount. Remaining amount, you have to disallow, you have to add. Then 3617 talks about any bad debts which you write off as irrecoverable in the books of account. Provided that debt has been taken into account in computing the income. That is important. Debt should have been taken into account in computing your income. That debt is written off as bad debts in your books of accounts, then the same will be allowable as deduction. It is not necessary for you to prove that the debt is bad. You simply have to, it has to be written off in your books of accounts. Then you will be eligible for deduction in respect of that bad. This comes as additional information. You have to reduce this amount when you're computing profits and gains of business. Then here comes a very tricky question. This thing which is asked many a times in the examination and students make a mistake in this adjustment. It's a bona fide expenditure incurred by a company for the purpose of promoting family planning amongst its employees. So, and if the expenditure is capital expenditure, 1/5 of the expenditure is allowable as deduction in the current previous year and balance in 4 equal installments in the 4 subsidies. Revenue expenditure incurred by a company is fully allowed and capital expenditure 1/5 is allowed in the current year and 4/5 is allowed in the subsequent years. But what happens is, generally at the intermediate level, the assessee will be an individual assessee, individual employer. And if he has incurred any sum promote family planning of his employees, whether it's a revenue expenditure, whether it's a capital expenditure, no sum will be allowed as deduction. 3619 will not apply in the case of an individual assessee at all. It is only for companies. Please note this. An adjustment relating to family planning expenditures coming in your exam, no amount is to be, if it's given as additional information, don't give any treatment. If it has been already debited to your P&L account, then you must add back because it's not allowable as deduction in case of an individual. Okay? It's allowed only for a company For a company, revenue expenditure is fully allowed, capital expenditure 1/5 is allowed, and remaining 4/5 has to be added back. In case of an individual, no deduction for family planning of employees. Whatever expenditure you incur for family planning of your employees is not allowed as a deduction. Then 36(1)(15). Place is open now. 36(1)(15) is amount equal to securities transaction tax paid in respect of taxable securities transactions entered into in the course of business. See, my business is dealing in securities, dealing in shares, then it's my business income. Then whatever securities transaction tax which I pay, I am eligible for deduction under 36. Provided the income from taxable securities transactions is chargeable to tax on the inherent profits and gains of business operation. Here students should appreciate there's a difference. If I hold shares as my capital asset, they sell the shares. Capital gains chargeable to tax under capital gains. There, when it's chargeable to tax under capital gains, I don't get securities transaction tax as a deduction. But here, in this case, which is if I'm a dealer in shares, if I'm a dealer in securities, same is chargeable to tax as my business income. Then, in which case the securities transaction tax which I'm paying is allowable as deduction under 36(1)(15). Likewise, commodities transaction tax is also allowable if my income from taxable commodities transaction is included in the profits and gains of business. So, in all these deductions from 30 to 36 are permissible deductions subject to fulfillment of conditions. And if the assessee is eligible for these benefits, then these deductions have to be provided for. They have not already been debited to P&L account. These deducted while computing your profits and gains of business. And in case of if they've already been debited to P&L account, then you need not make any adjustment. But if they've not been debited to P&L account, you will have to make necessary adjustment. Now you come to the general deduction under section 37. General deduction is not only expenditure listed in 30 to 36, but also any other expenditure to incur wholly and exclusively for the purpose of my business and profession be allowable under section 37. However, expenditure which is of capital nature is not allowable. Expenditure which is personal nature is not allowable. Like for instance, I said now motor car. I'm using 1/4 for personal purposes, 3/4 for business purposes. Only 3/4 of my motor car expenses is allowable as deduction. 1/4 is not allowable because it's personal expenditure. Likewise, if drawings is debited to my P&L account, that is not allowable because that is once again my personal expenditure. Municipal taxes for my residential house property, not allowable. It's once again my personal expenditure. It's not allowable under this head. Okay, so if all those any personal expenditure or capital expenditure has been debited to P&L account, you have to add it back. Suppose the cost of motor car has been debited to my P&L account. I first add it back because capital expenditure is not allowable. Then I provide depreciation on that. If 3/4 is only used for the purpose of my business or profession, 3/4 of that depreciation only I have to deduct. Then the expenditure should not be for any purpose which is an offence or which is prohibited by law. That is again very important. It should not be a purpose which is an offence or which is prohibited by law. And it should not be an expenditure incurred by the assessee on corporate social responsibility, which is required under the Companies Act, section 135. The Companies Act. If it's towards CSR activities, then it will not qualify for deduction under 37. So it should not be any expenditure which is not covered by 30 to 36, but is incurred wholly and exclusively for the purpose of business, will qualify for deduction under 37, provided it is not capital expenditure, provided it is not personal expenditure, provided it is not expenditure in the nature of any offence, provided it is not a CSR. Then 37(2)(b), any expenditure for advertisement in souvenir, brochure, tract, pamphlet published by a political party that is not allowable as deduction. You can't claim that as a business expense. Deduction of business expense. If it is debited to your P&L account, you have to add it back. Now we come to amounts not deductible. 40 provides for certain amounts which are not deductible. hands of the assessee. Even if it is allowed under 30 to 36, because you have not fulfilled some conditions, these amounts are not deductible. First is 40A1. 40A1 talks about any interest, royalty, fee for technical services, or any other sum chargeable under the Act. Okay, any other sum. Ultimately, they've specified interest, royalty, fee for technical services. Finally, they've said any other sum chargeable under the Act. Which is payable outside India or in India to a non-corporate, non-resident or a foreign company. Okay, in India, it's payable to a non-resident or a foreign company. In the case, tax has not been deducted. And the entire sum is disallowed. You are not deducted tax, or having deducted tax, you have not remitted it to the government on or before the due date for filing return. Due date for filing return under 139(1) is what? It's 31st July on tax audit cases, 30th September in tax audit cases. Basically, these are the, in case of firms. So, accordingly, if you have not deposited the tax which you have deducted on or before these dates, then the entire amount has to be added back. But otherwise have incurred it, you might have paid it by account, pay, check, all other conditions might have been satisfied. But still, because you have not deducted tax at source, or having deducted tax at source, you have not remitted it to the government before the due date for filing. The entire amount will have to be added. However, suppose I deduct tax in the next year, or I remit it after the due date for filing return, then in the next year it will be allowable as a deduction. The year in which the amount is so deducted and paid, that year it will be allowed as deduction. So, case, let me do 40A1A also. Then, that is a case of non-residence where the entire amount is disallowed or payments outside India. Now, if suppose it's a resident, suppose I am making a payment to a resident, all these payments on which tax is deductible at source. I am making payment of interest, tax is deductible at source under 190, payment for fee for professional services, tax is deductible under 190. For technical services, tax is deductible under 190. Taking these payments without deducting tax at source. Okay? Or I deduct tax at source, I don't remit it to the government on or before the due date for filing return. Here, because they are residents, only 30% is disallowed, not 100%. In case of non-residents or payment outside India, 40A1 applies and 100% is disallowed. In case of residents, only 30% is. And next year, if I make the payment after the due date for filing return, then will be allowed as that 30% which I disallowed this year will be allowed next year. So what will happen? Normally what you should consider is, suppose it's a current year expenditure on which I have not deducted tax at source. Generally what is asked in exam is residence. 30% of that, 1 lakh is the expenditure, 30% of 1 lakh, 30,000 will be disallowed. And next year when I am making the payment, so 30,000 I will have to add back when I am computing my profits and gains of business. Or in the contrary, what they would have given last year, so much of tax was deducted at source for which remittance was made only in the month of November. So what it means, last year it would have been disallowed, 30% would have been disallowed for non-deduction of tax at source. Because the remittance was after the due date. But since it is paid in the current previous year, that 30% of that expenditure, I will get deduction in this year. So last year, with a sum of 2 lakh, been paid towards interest. 30% would have been disallowed for non-deduction of tax or non-remittance of tax. 60,000 would have been disallowed. That if I am paying in the month of November. That 60% I should allow as deduction this year when I am computing my profits and gains of business. However, if current year expenditure, I am not deducting tax itself, so I am not remitting it. Then I have to add back that amount. That's a difference. Current year I am not deducting tax or I am not remitting it. I have to add back that amount because it's a disallowance. Last year, if there was a disallowance because of non-deduction, which I am subsequently remitting, because subsequently it's been remitted, I have complied with the condition, this year it will be allowed as a deduction, only 30% only. 30%, 60,000 will be allowed as deduction. This you must be very careful. Another mistake which students tend to make is, the time given for deduction is only end of the previous year. Only for remittance I have time up to due date of filing return. Suppose fee for professional services I have paid to one Mr. X, paid him 1 lakh rupees in March, but I have not deducted taxes. April, again I have paid him another 1 lakh rupees. In April I am deducting for both March and April. For 2 lakh rupees I am deducting 10%, 20,000 and I am paying remaining 80,000. The deduction for that March payment has not been made in March. It has been made after the end of the previous year. It is on to the next previous year. So even if I remit that 20,000 very quickly, I remit it in the next month itself. Still, my deduction was not made in the previous year. It was made only after the end of the previous year. The essential condition is deduction has to be made in the previous year. Remittance has to be made on or before the due date of filing. If deduction itself is postponed to the next year, then again 30% disallowance will be. There is a question in the study material also. Many students have raised this issue. They don't understand. Because remittance is made before the due date, they are asking why deduction is not allowed. Because the deduction has been made after the end of the previous year. That's why 30% disallowance is made. 48(2) disallowance is any sum paid on income tax. Income tax is paid, then no deduction is allowable. You have to add it back. That I can't claim as deduction. Similarly, 48(3), any payment which is chargeable under salaries, if it's payable outside India or to a non-resident. Suppose I'm paying salaries, I'm an employer paying salaries to a person outside India or to a non-resident. Okay. Then if tax are not deducted, then that entire sum will be disallowed. And 40A5 is tax paid by the employer on non-monetary purposes provided to its employees. It is exempt under 10 cents. Now, an employer salary to salary comprises the basic was by the employer. But on the perquisite component alone, the employer has the option to pay the tax on his own. Okay, that is, he is giving an additional benefit for the employee. He is not subjecting the employees to tax, but he is agreeing to pay the tax on his own. Now, what happens if he is agreeing to pay that tax will not be included once again as a perquisite in the hands of. Likewise, the employer, he cannot claim the benefit of the tax so paid on the perquisites of employees as deduction. If he claims such tax so paid, non-monetary perquisites as deduction, then you have to add it back. Because it's not an allowable expense. Business. So these are all the disallowances. Payments without deduction of tax excess, income tax, tax paid by the employer on non-monetary. Now we come to a case of partnership funds. Why is it important? Because this deduction is important because even though in your exam question they ask you relating to individuals, maybe they may not ask you directly relating to partnership funds, but still, only to the extent deduction is allowable on the hands of the will the taxability arise in the hands of the partner. So 40B lays down the limitations and restrictions for allowability of salary, remuneration, commission, bonus, or interest payable to partners. Now let me put it in a nutshell. In case of interest is, first of all, any payment should be authorized by the partnership. It should be for a period after the particular relevant clause is included in the partnership deed. It cannot be to any person prior. Like I can't put a clause in the partnership deed on 1st of October. Pay interest with effect from 1st of April 2019. 1st October 2019. If I include a clause in the partnership deed to pay with retrospective effect from 1/4/19, for income tax purposes, I will get the deduction only from 1st of October, not from 1st of April. So that is one point which you should keep in mind. Then okay, it's for a period falling after the date of the partnership deed. Then also, if the partnership deed permits interest of 15%, but still Income Tax Act, there is a restriction that you can allow only maximum of 12% and not 15%. Suppose 15% has been paid, the balance 3% will have to be added back while computing profits and gains of business. Okay. First of all, the payments must be authorized. Then in case of salary remuneration, there's another condition. It can be paid only to working partners. Working partner is a person who is actually actively engaged in the affairs of the firm. So salary, bonus, commission, remuneration can be paid only to working partners. It should be authorized by the partnership deed. It should be for the period after the relevant clause is included in the partnership and subject to certain limits. How is the limit calculated? Okay, it's profit comes. What is book profit? Book profit is the net profit shown in the profit and loss account for the relevant previous year, applying all the provisions which we've seen so far, giving all the 30 to 36 deductions, taking all the other disallowances, deductions not allowable, you add back. After that, you finally compute the profits and gains of business. Then you add back remuneration to partners. It's already been debited to P&L account. The remuneration to partners, you add back that excess interest which you paid to partners now, because it's beyond 12%, that also you add back. Then you arrive at the book profit. From the book profit, suppose your book profit is 10 lakh. So, for the first 3 lakh of book profit, get 1,50,000 or 90% of book profit, whichever. So, in this case, if suppose your book profit is 10 lakh, for 3 lakh, first 3 lakh, you get 2,70,000. The permissible limit. Balance 7 lakh is 60%, 4,20,000. 2,70,000 plus 4,20,000 will give you 6,90,000. It's the permissible remuneration. If you paid a remuneration higher than that, if your partner's remuneration is say 8 lakh, then it will be restricted to 6,90,000. If it is below that, if it is only 4 lakh or 5 lakh, whatever, any sum below 6,90,000, you will get it in full. Because this is the maximum limit. So how do you compute the book profit? You take the net profit, you give all the permissible deductions like you do, and whatever is not allowable, you add back. Then partner's remuneration, if it's already been debited to P&L account, that also you add back. Interest, if it's been paid excess of 12%, that excess interest you add back. Get the book profit. First 3 lakh of book profit, suppose the book profit is 10 lakh. First 3 lakh ke liye you get 2,70,000. Remaining 7 lakh, you get 60%, that is 4,20,000. 2,70,000 plus 4,20,000 is 6,90,000. That is the maximum remuneration which is allowable to all partners. The firm has paid a higher amount, it has to be restricted to 6,90,000. If it's paid a lower amount, yeah. Whatever has been allowed in the hands of the firm, chargeable to tax is business income in the hands of the partner under section 28. So the head profits and gains of business. Now there are certain other deductions which are not allowable. I'll have to rush through because the time is very limited. We are already at 9:55. I'll be taking half an hour more, but I think I have to keep 10 minutes for answering queries. So we have to rush. 40A2 is any expenditure which you're making, for which payment is made to a related person to the extent it's excessive or unreasonable. As far as the exam is concerned, they will clearly specify what is the excessive or unreasonable. So they say 10,000 is reasonable, you have paid 12,000, so 2,000 is excessive. But what you must consider is what is a related person. Whether the payment is a related person, whether it falls within the definition of it. So examples are given here. For individual, it's a relative of the individual. Suppose payment is made to an individual. Relative means husband, wife, brother, sister, or any lineal ascendant. My mother, my grandmother, my lineal ascendant. My son, grandson is my lineal descendant. Husband, wife, brother, sister, lineal ascendant or descendant. Suppose I've made to these people, then disallowance is attractive. Firm means it's any partner of the firm or relative of the partner. HUF AOP means any member of the AOP or HUF or any relative of member, that will be the relative. Company means director of the company or relative of the director. Any assessee means for any assessee, an individual who has substantial interest, 20% or more voting power, or entitlement to 20% or more profits, the business, he would be considered to be a relative person, or any relative of such a person is also a relative. Relative again, it means this only: husband, wife, brother, sister, lineal ascendant, descendant. Now 40A3 is in respect of any expenditure in respect of which payment or aggregate of payments is made in a single day, otherwise than by account pay check, account pay bank draft, exceeding 10,000. If I have made any such expenditure for which the payment exceeds 10,000, then the same will be disallowed. Then if it's to a transport operator, instead of 10,000, up to 35,000 is permitted. Otherwise than by way of account pay check or bank draft or ECS or prescribed electronic. Here you should note that this disallowance is not attracted in cases mentioned in rules. What are the cases mentioned in Rule 60? Basically, it's payment to RBI, payment to SBI, payment for agricultural produce, payment for fisheries, horticulture, apiculture, then payment by debit card, credit card. Then this one, suppose I'm an employer and I'm paying salary to an employee who's been posted for a period exceeding 15 days at a different place or in a ship, and he doesn't have a bank account at that place. Then I'm permitted, provided I've deducted tax excess from his payment, I'm permitted to make a cash payment. Go through Rule 60D. I'm just telling you some examples as a detailed list. Those cases is listed out in Rule 60D. Also, payment on a day when it's a bank holiday or when bank is on strike. That is again an exception. So, in these cases, this disallowance will be applied. And 48.3a talks about a case where I allow an expenditure on due basis. I'm following mercantile system accounting. I allow it on due basis, and thereafter in a subsequent year, I'm making a payment exceeding 1,000 to a person in a single day. Otherwise than by these modes, then again, in excess of 10,000 or 35,000 in case of transport operators, there again it will be treated as my income. Be treated as income of that year. Because I've already been allowed deduction on due basis in an earlier year, this year it will be treated as my income. However, here again in Rule 60D cases, this will not apply. If I'm skipping through others, provision for payment of gratuity to employees. That will not be disallowed. However, disallowance will not be attracted if provision is made for contribution to approved gratuity fund, payment of gratuity that has become payable to during the year. Suppose the provision for payment of gratuity is say 10 lakh, out of which contribution to approved gratuity fund is 4 lakh, and payment of gratuity become payable during the year is 3 lakh. Then 4 plus 3 lakhs will be allowable. The 10 lakh minus 7 lakh, 3 lakh will be disallowed, so it has to be added. Again, I'll take only the important provisions. Suppose I've been allowed a deduction in respect of any loss or expenditure or trading liability in a particular year. Thereafter, in another year, the assessee or the successor of business has obtained any amount in respect of that loss or expenditure or benefit in respect of a trading liability by way of remission or cessation. The value of benefit will be my income. See, suppose I purchased raw materials on a due basis. I'm not able to pay my creditor. He waives off that amount. The 2 lakh already have debited my purchases and I've claimed the deduction for a year. Now that liability is being remitted, 2 lakh liability. The 2 lakh will be or suppose he remits one portion of it. He remits 50,000. Then that 50,000 will be treated as the income of. Likewise, any bad debts which I've written off in any year, 41(4) if I've written off bad debts in any previous year, I'm recovering that bad debts in the current year, then the bad debts recovered will be my income. The deeming provisions. 41 contains the deeming provisions. Now this again is a very important section. Like suppose I'm an assessee claiming expenditure on mercantile basis. Claiming all my expenditure on mercantile basis. But 43B provides certain expenditure which I can claim only if I have made the payment on or before the due date for filing return of income under section 139. Even if I am following mercantile system of accounting, still I have to make the payment on or before the due date. Only then I will be eligible for deduction. Otherwise, will not be allowed. What are those? Tax, duty, cess or fee under any law. Employer contribution to PF, superannuation fund or gratuity fund. Bonus or commission which is payable to employees. Then interest or loan which I borrow from a public financial institute, state financial corporation, state industrial investment corporation. Then from a deposit taking NBFC or a systematically important non-deposit taking NBFC if I pay any interest. Systematically important non-deposit taking in NBFC means whose total assets in the last audited balance sheet are 500. Then interest or loan or advance from a scheduled bank or a cooperative bank. All these instances, all these payments will be allowable as deduction even in case of an assessee following mercantile. If the payment is made on or before the due date of filing return. Even cashman, the employer pays his employee. Now let's come to other provisions. They are also very important. Like 43CA provides where I'm transferring an asset. Let me take the same example like I'm a dealer in buildings. I'm transferring the building. It's my stock and trade. I'm transferring it. Then my actual consideration is 10 lakh. Okay. And I'm transferring it for say 16 lakh. My actual consideration is 10 lakh, but my stamp duty value on the is 16 lakh. Then my stamp duty value will be taken as my full value of consideration and not my actual consideration. While taxing income under the head profits and gains of business or profession, because I'm a dealer in buildings, so it comes under profits and gains of business or profession. If it's my capital asset, it would have come under capital. What is the asset covered here? Land or building or both. It's only in the case of land or building or both. I take the stamp duty value into consideration. Here again, stamp duty value, whether I should take it on the date of agreement or on the date of sale. Suppose on the date of agreement, suppose there's a 3-month gap, on the date of agreement, my stamp duty value is much over. I would prefer to take that. I can take it only if some portion of the consideration is received by me by electronic mode, account pay check, account pay draft, on or before the date of agreement. If I have not received it, or if I have received it by cash, then I cannot consider the stamp duty value on the date. Also, some concession has been given. See, if my consideration is 10 lakh, my stamp duty value is up to 15 lakh, up to 105% of the consideration. That is 15 lakh. Then I need not make any adjustment. My actual consideration will be will be taken into consideration for computing my business. However, if it is 16 lakhs, then it exceeds 105%. Then I have to take the stamp duty value. Here is where it will help if I have my date of agreement on a different date, it's an earlier date, and that in that date it was only 14 lakh, and I may receive some amount by way of account pay check. Even if it is only a meager amount of 10,000, I have received it by way of account pay check on or before the date of agreement. Then I can consider 14 lakh. What is the benefit in considering 14 lakh on the date? Because it falls within that 5%. Then I can take 10 lakh only as my income. I need not take my stamp duty back. That is the benefit. This is 43. Go to skip compulsory maintenance of books of accounts because we don't have time for that. I would just take you to 44AB and presumptive taxation. 44AB is mandatory audit of accounts. When is audit of accounts mandatory under section? In case of a person carrying on business, his total sales, turnover or gross receipts exceed 1 crore in the previous year, then audit becomes mandatory. In case of a person carrying on business or in case of a person carrying on profession, its gross receipts and profession exceed 50 lakh in the previous. In these cases, tax audit becomes mandatory. So also mandatory in other cases of presumptive taxation where the assessee wants to claim lower profits. That I will take up when I deal with presumptive taxation cases. See, though the limit for business is 1 crore, if a person wants to opt for presumptive taxation under 4480, person is turnover of up to 2 crore, he can opt. So up to 2 crore, if he opts for presumptive taxation, then he need not get his accounts tax audited. But if he does not opt for presumptive taxation, he has to get his accounts audited. Now, this is one of the most important provisions in profits and gains of business. And these provisions are introduced, presumptive taxation provisions have been introduced in order to facilitate ease of compliance by the assessees. So there are 3 presumptive taxation provisions which are relevant for resident assessees. 44AE is relevant for both residents and non-residents. AD and ADA are relevant for resident assessees. And you are exempted from maintaining books of accounts. You are exempted from conducting tax audit under 44, provided you fulfill certain conditions. Who are eligible and who are the assessees eligible, who are the businesses eligible to receive that. Now, in case of 44AD, who is the assessee? 44AD is for businesses. It's for eligible businesses. And 44ADA is for notified professions. 44AE is for person owning goods carriages. Broadly. Now, who is the eligible assessee for 44AD? He has to be a resident, individual, HUF or partnership firm, but not LLP. Who is engaged in eligible business. What is eligible business? Any business other than the business of carrying on goods carriages whose total turnover does not exceed 200 lakhs. That is an eligible business. And who has not claimed deduction under 10AA or Deduction in respect, under Chapter 6A, deduction in respect of certain incomes like APIA, APIB, they should not have claimed that. Then they are an eligible assessee. However, this doesn't apply to following persons, 44A. In case of persons carrying on professions specified under 44A, medical, legal and all, they will be eligible for 44ADA presumptive. Person earning income in the nature of commission or brokerage and person carrying on agency business. These people will not be entitled to 44AD at all. They will not be entitled to opt for 44AD. If you are having income in the nature of commission or brokerage or agency business, or you are carrying on profession under 44AA. Now coming to 44ADA, who is the eligible assessee here? Here again it should be a resident assessee. He should be engaged in any profession under 44AA. Wrongly typed as 4AA, it should be 44AA1. Legal, medical, engineering, architecture, accountancy, interior decoration, technical consultancy, these are the notified professions. And if you are engaged, you will be eligible for presumptive taxation under 44AD. Then 44AE is an assessee owning not more than 10 goods carriages at any time during the previous year. Okay? At any time, you should not exceed it. You should not own more than 10. It's not that in April he owns 12, but by the end of the year it becomes 5, he won't be eligible. For the previous year, he should not own more than 10 goods. Now, what is the eligible business or profession? As I said in 44AD, the eligible business is any business other than business of flying, hiring or carriages, and whose total turnover or gross receipts in the previous year does not exceed 200 lakhs. 200 lakhs is the turnover limit here. For next one is the 44ADA. 44ADA, what is the turnover limit? The gross receipt limit is 50 lakhs. So up to 50 lakhs, a professional can claim presumptive taxation provisions. If it exceeds 50 lakhs, he cannot claim. And the third one, there is no limit as such. It's a business of flying, hiring or leasing goods carriages. You should not own more than 10 goods carriages. That is the condition. Now, what is the presumptive income in these cases? 44AD, the presumptive income is 8% of total turnover, sales or gross receipts or any higher sum. Suppose the assessee wishes to claim 9%, 10% or higher sum, he is free to do, but 8% minimum he should claim. And suppose in respect of a turnover, which he has, suppose the assessee is following mercantile system of accounting. Some part of the turnover is received by way of accounting, account pay check or bank draft or ECS or prescribed electronic notes on or before the due date for filing return of income. In respect of that portion of the turnover, he can claim the benefit of 6% rate of presumptive income. Okay, like suppose your total income is 10 lakh. Okay, out of which 3 lakh you received by way of account pay check, account pay bank draft before the due date of filing return. For 3 lakh you can claim 6% income, and for 7 lakh you can claim 8%. This is the minimum amount you can claim any sum higher than that. And here students should note that this 8% and 6% are, when you multiply 8% of total turnover, when you multiply 6% of total turnover of gross, what you get is the income and not the tax. Many students mistake it for tax and write that that is the tax liability. It's not the tax liability. That will be the income. On that income, you have to apply the rates of tax and compute the tax liability. Please remember this. Because this is one of the mistakes which students commonly make. This is in case of 44AD. In case of 44ADA, it's 50% of total gross receipt profession. Or any higher sum which the assessee can claim. 50% minimum they have to claim, they can claim a higher sum also. Then for goods vehicle, how do you compute the amount? Here the vehicles are divided into two categories. Heavy goods vehicle. Heavy goods vehicle is a vehicle for which the gross vehicle weight is more than 12,000 kg. What is the gross vehicle weight? The weight of the vehicle plus the weight of the permissible load of the vehicle. That is the gross vehicle. That should exceed 12,000 kg, in which case it will be a heavy goods vehicle. Then what is the presumptive taxation? 1,000 per ton of gross vehicle weight or unladen weight for every month or part of it. This 1,000 per ton, and it's per month also. Of gross vehicle weight. What is gross vehicle weight? I have already told you. Unladen weight, if suppose a vehicle has a trailer also attached, the weight of the trailer or alternative equipment which is attached to the vehicle, the heaviest alternative. That is unladen. So in case of other than heavy goods vehicles, suppose the gross vehicle weight is less than or equal to 1000 kgs, then how do you calculate the presumptive income? 7,500 per month or part of the month in which the vehicle is owned by the assessor. Here again, how many months he is put to use is of no relevance. It is the number of months of ownership which is relevant. Please note this. He may have used it for a lesser period. He might have acquired it in July. He might have used it in October. But from July, you have to compute the presumptive income. Delay it up to October. In all these cases, the assessee is free to declare a higher sum than the presumptive income. So the minimum amounts which he has to declare. Now, all deductions, the 30 to 38, because it's a presumptive provision, all deductions under 30 to 38 are deemed to have been given full effect. And in case of 44 AD and ADA, even partners' salary and interest. In case of a partnership firm, salary and interest paid to partners is also not allowable as deduction for 44 AD and ADA. For 44 AE alone, in case of a partnership firm, they can claim deduction of salary interest subject to limits laid down in 40B. That is only for 44 AE. Go through the comparative chart. It's given in your study material also. This will help you to understand it in a better manner. Written down value of the asset will be deemed to have been calculated as though depreciation has been claimed and fully allowed. Even though depreciation is not allowable, WDV will be calculated on that basis as though that depreciation has been claimed and fully. Requirement of maintenance of books of accounts. Suppose you claim profits as on presumptive tax basis, then there's no need to maintain books of accounts under 44A, no need for tax audit under 44. But there are circumstances where you will be required to do it. Suppose under 44AD, person starts claiming profits on presumptive basis, he is claimed for assessment year 2020. Thereafter, assessment, then he has to continue to claim it for at least 5 years. If he breaks in assessment year 21-22, say he does not claim presumptive tax, then he cannot claim presumptive taxes for a further period of 5 years. 22-23, 23-24, 24-25, 25-26 and 26-27. 5 further years cannot claim presumptive tax basis. Then what will happen? He has to compulsorily maintain books of accounts and get them audited. His total income exceeds the basic exemption. This is a violation in 4484. Once you start claiming presumptive taxation, you have to claim it for a period of 5 years. If you don't claim it for a period of 5 years, then not only that particular year, in between, suppose I claim it for 2 years, third year I don't claim. After third year, then 4th, 5th, 6th, 7th and 8th year, I can't claim presumptive tax. Then, for the year in which I am not claiming, as well as in the 5 successive years, I have to maintain books of accounts, I have to get them audited. My total income exceeds the basic exemption. Now coming to 44 ADA. 44 ADA, the assessee has to declare 50% minimum as his income. Suppose he feels that his income is much lower, he is maintaining books of accounts. He feels that his income is only 30%. Then he has to maintain books of accounts, he has to get them audited. His total income exceeds the basic exemption. Likewise, in case of 44 AE, the assessee wants to claim lower income than 1000 per ton in case of heavy vehicle and 7500 per month in case of other than heavy goods vehicle. He has to maintain books of accounts and get them audited. Here, audited under 44 AB. Here, they have not mentioned if the income is above the basic exemption limit. Even if it's not above the basic exemption limit, you still have to comply with 44 AB and 44 AB. The case of business of flying, hiring and leasing goods carriages. So these are the presumptive tax provisions. If a person is not covered under presumptive tax provisions mentioned above, audit of books of accounts is mandatory. If the total sales turnover of gross receipts exceed 1 crore and in case where he carries on profession, his gross receipts in profession exceed 50 lakh in the previous. Sorry, I had to rush through because there is very less time. Here again, composite income is again very important. So composite income is what is the income comprises of both agricultural income and business income. Agricultural income is exempt from tax, business income is chargeable to tax. But there are certain businesses which have a composite income. They are income from growing, manufacturing, tea, rubber and coffee. So, in order to make the matter simple, there have been rules have been inserted in the income tax rules specifying what is the proportion which is the business income, what is the proportion which is the agricultural income. So, in case Rule 7A deals with income from growing and manufacturing rubber, 35% is business income, it's chargeable to tax, 65% is agricultural income, which is exempt. Rule 7B deals with income from growing and manufacturing coffee. The coffee is only grown and cured. 25% is business income, 75% is agricultural income. But if it's grown, cured, you're undertaking further processes like roasting and grounding. Then a higher percentage will be business income. 50% will be business income and 60% will be agricultural income. Then Rule 8 is income from growing and manufacturing tea. Then 40% is business income and 60% is agricultural income. Note one thing which has to be noted here, all this growing and manufacturing should take place in India. Only then this rule will apply. If it's outside India, the entire income will be taxable. Only if it's in India, because only agricultural income in India is exempt. So the growing of rubber, coffee and tea has to be in India for this rule to become applicable. So I will stop with this. Now I have 10 minutes to take up your queries. I'll stop sharing the slide. Jayasurya Yadav. He has written, one partner is getting salary from the firm and it is taxed in the hands of the firm. Again, now in the hands of the partner, it's taxable. It is not taxed in the hands of the firm. Salary is deductible in the hands of the firm. Salary which the firm is paying to the partner is deductible in the hands of the firm. Suppose the 40B conditions are fulfilled, it will be deductible. And only if the deduction is allowable under 40B, it will be subject to tax in the hands of the partner. So it's not taxable in the hands of the firm. Some person, Paras is asking about Keyman insurance policy. What I took under income in the beginning, charging section 28, I took an insurance policy. Keyman insurance, suppose big companies, they insure the lives of the keyman because the keyman is very indispensable for running the company. He's been working in the company for several years and he knows the most. So ensuring his life is very important for me. Tomorrow, if I lose the keyman, I don't know how my business will suffer on that account. So I take an insurance on my keyman, who might be the CEO of the company or CFO of the company. I take an insurance, and because of some reason, mishap or otherwise, I receive the insurance proceeds. That insurance proceeds which I get from the insurance company as an employer will be my business income, which is chargeable to tax under section 20. Geeta Agarwal asked me 180 days means 6 months up to 30th September. No. Properly, you have to count 180 days. Days, it's not months. See, in the exam, they have given only cross-check. They have not mentioned account payee check. Then it does not actually fulfill the conditions of account payee check or bank. Account payee, you have to strike account payee. Here, cross-check, you are not fulfilling the condition. Then, which kind of firm or company additional depreciation is applicable? Additional depreciation, it depends upon not which kind of, if you are engaged in the business of manufacture or production of an article or thing, or in the generation or distribution of electricity. If you are doing that, then you are installing new plant and machinery. New plant and machinery. Again, second-hand plant and machinery won't qualify. If you have installed an office, residential premises, guest houses, it won't qualify. New plant and machinery if you've installed, and if you're engaged in the business of manufacture or production of an article or thing, or the business of generation of electricity, then additional depreciation you are eligible at 20%. If you set up in a notified backward area in the states of Andhra Pradesh, Telangana, West Bengal, or then you will be entitled for additional depreciation of 35%. The asset is put to use for less than 180 days, then half of the additional depreciation will be allowable. 10% in the normal cases and backward areas at 17.5%. Remaining half will be allowable in the next year. Hey, Nitya, it's not, 35% is not over and about 20%. It is 35% overall. Instead of 25%, it is 35%. Then Commencement dates important for exam. Yeah, for 35 AD deduction, you have to remember the commencement. Important. Like suppose state to specify a date prior to the date of commencement of business. Whatever stated under 35 AD. Prior to 1/4/2010, prior to 1/4/2012, infrastructure facility prior to 1/4/17, then those businesses will not qualify for deduction under 35 AD. For 35 AD, it becomes important to remember the date. The commencement dates are very much there in the study material. I have not given it in that table which I showed you, but it's separately given. Just go through the chapter carefully. Commencement dates are very much. Generally, I'm not able to understand your question very clearly. For 35 days, 35 AD, what I said was, once you claim 35 AD deduction, it is mandatory that for 8 years I use it for my specified business. After 8 years, if I'm going to use it for some other business, it's okay. But within the 8 years, I should use it only for my specified business. If I use it for some other business, then whatever deduction which I've already claimed 35 AD deduction minus the depreciation that would have been allowable had I not claimed the deduction, that would be deemed to be my income. However, if I transfer it after the 8-year period, then there is no problem. There is no tax liability which is occurred. But in case I'm going to sell my asset which I purchased, for which I claim 35 AD benefit, then the sale proceeds will be taxable as my business income. Municipal taxes paid by business for business purpose. Yeah, if it's paid by business for business purpose, it's allowed as only if it's in respect of a house property, which is income from a house property, which is chargeable to tax on the profits and gains of business and profession, then you should add it back. Is it mandatory to mention section number while writing the answer? No, it is not mandatory to write the section number while writing your answer. It's not mandatory. The problem is that what I would advise all of you is that when you read something along with the section, it helps you to remember the provision in a better manner. I mean, it's very difficult to provide deduction under ATC without actually mentioning it that it's a deduction under ATC, or deduction under ATD without mentioning it's a deduction under ATC. But I feel the learning process becomes easier if you learn it along with the section. Because you don't need to remember the specific clauses, subclauses and all that. But broadly, sections, if you remember, it is very useful for your learning process, and also the examiner will get a better impression that you know the provision very well. So actually, it's not mandatory, but it is desirable. I hope the audio clarity is good now. Somebody has written, but it was not okay in between. Thereafter, I started using the headphone. Is deduction under 32 AD in addition to the additional depreciation? Yes. If you are set up in a notified backward area, you get 15% under 32 AD investment allowance, plus you get an additional depreciation of 35%. That very much added incentive. You get the normal depreciation also. You get the normal depreciation, higher additional depreciation at 35%, plus investment at 15%. Seven, I really don't have time. It's a revisionary class. If I start solving illustrations, I wouldn't have been able to complete the provisions at all. You can see the illustrations given in the study material. It's explained very clearly. I advise all of you to do all the illustrations and the exercise. It's very much important. You will be able to understand the provision in a better manner. In fact, what you should do is you should read the concept, you should read the provision, and you should work out the problem on your own. Don't read the illustration. Work out the illustration, thereafter compare it with the solution given therein to find out where you've gone wrong. If you do that exercise, then you'll gain a lot of confidence. Even though initially you might make mistakes, ultimately you'll gain a lot of confidence because you would have understood what your mistakes is, and you would have rectified it also by the time you do the exam. So work out all the illustrations, all the exercise questions given in your study material, the RTP, the MTP, sample questions which are MCQs which are hosted on the website, everything you have to work out. It'll help you to understand the provisions and apply the provisions in a better manner. See, in case where a person owns a apartment and lets it out, he pays some amount. Okay, that is a part of it's a composite rent case. I didn't have time to take up. If it's part of it is towards house property, part of it is towards service charges, and they can be separately identified and distinguished. Only the portion relating to house property will be chargeable to tax under the head income from. When we use 6 and 8% LASA, I think you are asking in respect of 4480. 8% you can use in respect of your entire turnover. Even if you've not received, suppose I'm following mercantile system of accounting, I've not received the amount, I can apply 8%. 6% when I will be eligible to apply. When I've received that turnover by way of account pay check, account pay bank draft, electronic clearing system, or prescribed electronic modes like debit card, credit card, RTGS, NEFT, net banking, all those things, if I've received by that mode, on or before the due date of filing return. Suppose, give an example, now 10 lakh, let me say my total turnover is 10 lakh, for simplicity's sake. Out of which 3 lakh, I'm an associate following mercantile system of accounting. Out of 10 lakh, 3 lakh I've received it by way of these prescribed electronic modes, on or before the due date of filing return. 3 lakh I can opt for 6%, 3 lakh into 6%, be my business income. So 7 lakh, I can do into 8%. 1 lakh into 8%, whatever I get. So these two figures added up will be my income. Once again, it's going to be my income, it's not my tax. So remember that. Self-occupied building means how much square feet land, how many rooms are there, that and all has not been specified in the Act. It can be any big building. Can be treated as self-occupied. You can have a huge bungalow and you can treat it as self-occupied. What is the due date for filing of return of income of business income? Suppose you're not subject to tax audit, it's 31st July, otherwise it's 30th September. There is a third due date also, but that's not relevant at the intermediate level. Limits for remuneration and interest to partners, as I said, interest limit is 12%. Remuneration, it depends on your book profit. First, 3 lakh of your book profit is just 90% of book profit or 1,50,000, whichever is higher. The remaining book profit is 60% of book. Provided the partnership deed authorizes such payment. And in case of remuneration, the payment is made to a working partner. So still not, one person is still not able to listen to the audio. I don't know what's the problem. I think the things have stopped now. I think the telecast has stopped. So wishing you all the best of luck for your examinations. I'm sure all of you will do very well. Just make sure that you revise all your concepts thoroughly, work out all the problems, work out the RTP mock test papers. I'm sure all of you will do the exams very well. Best of luck from Board of Studies. Thank you.